Okay, I'll move to security valuation now. This is technically not a single chapter. It is like two, three individual chapters which ICI has clubbed and made it as a single chapter. Ideally, this could have been broken down into multiple sub chapters. And this is the chapter which is going to take decent amount of time in our discussion also. Normally, I take around 2 days of discussion just for this one chapter because it's not a single chapter. When we start solving questions and revise internally also, I will do one part, revise that fully, and then we'll ignore it. That's all. Because here, this chapter alone will have 100 concepts, around 100 concepts will be there. Let's start understanding this. Security valuation basically means valuing any security. Security is a financial security. It could be equity, it could be a bond, it could be a hybrid instrument, it could be a money market instrument. Any instrument whose valuation is to be done is what we are learning here. Indirectly, I also have another valuation, which is business valuation, where some of these concepts will again get discussed. We will start going through first equity valuation, understand part of the equity valuation today, continue with equity valuation discussion in the next session as well. Some miscellaneous areas are also there. One area is called rights issue and buyback, and a small area called enterprise valuation is there in this chapter. We start with time value of money concepts, not very critical. I may not spend much time also on this. This is learnt at CA Inter as part of time value of money chapter. Practically extremely important concept. Here we have something called as future value. What is future values? Today's value, I take it to a future date. To take it to a future date, we do something called as compounding, multiply with 1 plus r the whole power n. You want to bring it to today, divide by 1 plus r the whole power n. Annuity means it is the same amount which is received or paid over a specified period. You want to take it to the future value, you multiply with future value annuity factor. You take it to today, you want to multiply with present value annuity factor. How is PVAF calculated? I'll explain maybe later on when we do question. FVAF is not that critical. We also have something called as perpetuity. What is perpetuity? Is there is no end to the cash flow. To value perpetuity, you will have to use your Gordon's formula or your cost of equity formula. What is cost of equity formula? KE is equal to D1 by P naught plus growth rate. Growth rate comes to the other side. KE minus G is equal to D1 by P naught, and P naught is equal to D1 KE minus G, which is what that formula. Cash flow 1 divided by discount rate minus the growth rate. Discount rate is cost of equity. Also, the annuity concept can help me in calculating something called as a loan installment amount. How can it help in loan installment amount? Concept is very simple. Loan amount is technically present value. Loan amount is technically present value is equal to annuity amount into present value annuity factor. Any loan you want to calculate EMI or equated annual installment, it is all through annuity factor. I'm not spending much time on this basics part. At home, I would 100% want you to complete these 7 examples which are there just to get little bit grip on this. Also in the same chapter, you will have ratios which I will not touch upon today itself, but I want you to go through ratios also and do the MCQs below the ratio. Now we start with equity valuation. In the equity valuation, there are multiple models of equity valuation which are there. The value of an equity share is arrived through the dividend paying ability of the share and the growth ability of a company. There are businesses which do not pay any dividends but still command good valuation, and there are businesses which pay steady dividends also. So a value of an equity share is because of two reasons. One, how much can you grow, and second is how much dividends can you pay. One classic example, Microsoft, which did not pay dividends for a very long period initially because they were growing at a rapid rate. So a growing company will command a good valuation. Also, a company which pays dividends will command. These are the two reasons I invest in a company. One, I expect dividends from them, or second, I expect capital gain from them. These are the two reasons we invest in a company. One principle of valuation which you need to be aware. This is something which should be very, very clear to you. Value of any asset you want to value. I want to value this pen which I have with me. How do I decide the value? You may say it's 2000 rupees, 3000 rupees. Logical value approaches present value of future cash flow, present value of future cash flow discounted at my required return, discounted at my required return. Somebody can say that this pen gives me some cash flow. Or let me take an example of a taxi. I am a taxi driver and I have a taxi. This taxi is going to give me some income. So what I need to do? Year cash flow. First year, taxi will give me 50,000. Second year, 2 lakh. Third year, 3 lakh. How will you calculate? Capital budgeting. You will learn calculation of cash flow using capital budgeting logic. Equity share. First year, how much dividend? Second year, how much dividend? Third year, how much dividend? Fourth year, how much dividend? At the end of fourth year, I'll sell it. At some stage, I'll have to sell it because it's infinite. There is no end to an equity share. Get year and cash flow structure of any asset. You want to value this building. First year, rent income. Second year, rent income. Third year, rent income. Fourth year, rent income. At the end of fourth year, sell it. Laptop, first year, benefit out of the laptop. If I can value. If you can decide that this is an income generating asset, put a value for the income which you generate. PVF at, what is PVF? Is discounting. You will discount this at 10, 12, 15, 18, 20, 25. What is this 10, 15, 12? This is the return which you expect from this asset. How will this be calculated? You will understand about something called as a CAPM approach. All that we will discuss. But basic logic is, what return do I want from the asset? If you give money to State Bank of India in the form of FD, you want 6% return. In the form of equity, same State Bank of India, you want 15% return. Same State Bank of India, FD you say you want 6% return. So if you want to value an FD, year cash flow PVF at 6%. You want to value a equity share of SBI, year cash flow PVF at 15%. PVF at 15%. Whatever return you want, this concept should be very, very clear to you. Any asset you want to value, because I'll discuss this in business valuation also. Anything you want to value, year, cash flow, PVF, DCF. This pen cannot generate cash flow. You cannot value using this logic. Use some other logic. There are multiple ways of valuing. Some other logic you use and then value. I want to value Bharadwaj Institute. Year, cash flow, PVF, DCF. First year, PAT plus depreciation 10 lakh rupees. Second year, 15 lakh. Third year, 20 lakh. Fourth year, 25 lakh. At the end of fourth year, we'll be selling Bharadwaj Institute to an investor. Let's assume I can do something like that. Year, cash flow, PVF, DCF. Once you are able to decide the structure, you can value any asset. Post your qualification, you may work some around, if you are at all you're working on valuation. Core concept is this only: year, cash flow, PVF, DCF. Whatever P multiple you do, whatever is the valuation, core concept is it generating money or not? Amazon, there is a value for Amazon. It all depends on what cash flow Amazon can generate. If money cannot be generated by a business for a very long period, value will start going down. Byju's had a huge value. Suddenly value started going down. Now almost very negligible value. Reason is cash flow generation is not happening. Concept is very simple: year, cash flow, PVF, DCF, best method of valuation. This is called discounted DCF method. They use the name DCF method. Can I use DCF for debt? Yes. Can I use it for equity? Yes. Can I use it for hybrid? Yes. Can I use it for money market? Yes. Can I use it for land, building, plant, machinery? Anything you can value, as long as it generates you some income. I am buying a car for my usage. You cannot value that car. You cannot value that car because it is not generating cash flow for you. If anything which generates a cash flow, I want to value laptop. Yes, it generates cash flow for me. I can do it. You are buying a laptop. It doesn't generate for you. You cannot use this logic. Clear? Understood this first core principle? Year, cash flow, PVF, DCF. Keep always this in mind. At few places you are not able to do anything. See whether this can be done. Year, cash flow, PVF, DCF to value an asset. The logic of that will be used at many places. First model of valuation we have is Walter model. Not very critical from an exam point of view, but still it is discussed at inter level, again discussed at final level. What did Walter say is value of a company comes out of two reasons. First reason is dividends which are paid. Second reason, dividends which should have been paid but you retain and you are going to give this money later in future. First reason is dividends. Second reason is retained earnings. Why retained earnings also gives me a value? Because instead of giving me this money today, you are telling me I'll give you something excellent in future. That is what Microsoft did. They did not pay dividends for a long period with a hope that they'll pay huge money in future. People may be okay with it. So first part is dividend, second part is capital appreciation. Plus this is the value of the company. First part is called D by K. Where is this formula coming in? The formula is coming from this. K is equal to D by P naught. Ignore the growth rate for the time being. P naught is equal to D by K. D by K. No D1, D0 headache here. You will see that as we proceed in Gordon's model. D by K. This is one part of the valuation. Second part of the valuation is I retain some money. Whatever money I retain, this retained money can be extra beneficial for me or can be a disadvantage for me. What is extra beneficial and disadvantage? Whatever I am retaining, I will multiply this with a number which can be greater than 1 or less than 1. I'll multiply this with a number which can be greater than 1 or less than 1. Like I said, when I do capital adequacy ratio, we attach a risk weight. For the retained earnings, the model says that you can multiply this with 1.5, 2, 2.5, 3, 3.5, 4, or you can multiply with 0.5, 0.2, 0.1. Either you give huge value to this number or you give a lower value. What is that value? That is called R by KE. What is R? Return on equity. What is KE? Cost of equity. What is cost of equity? Now, for this chapter, you are the shareholder or investor and I am the company. So, what is cost of equity? What you want? You want 10%. I am an excellent company, Microsoft. 25% I am generating. Return on equity, 25. If I can generate 25 and you want only 10%, I'll not give you any dividend because I will retain the money and give you huge money in future. Give you huge money in future. You want only what? 10%. And I am capable of generating 25%. So whatever I retain has a multiplier called 25 by 10, 2.5 times value you give for that. 2.5 times. Whatever is the profit earned. If 10 rupees is earned, you can put 4 here, 6 here. You can put 2 here, 8 here. You can put 0 here. You can put 10 here. Whatever you paid is into 1 only. There is no extra benefit. Whatever I retain can have a multiplier of 1, 1.5, 2, 2.5, 0.5, 0.2, 0.1. What is that multiplier? R by KE. Logical. If that multiplier is more than 1, retain money. If that multiplier is less than 1, pay out the full money. Pay out the full money. Terms used. D means dividend per share. How will you calculate dividend? Total dividend divided by number of share. EPS into payout ratio. What is EPS? The profits generated by the share company into payout ratio is called dividend. Into retention ratio is called retained earnings. Dividend rate into face value. Dividend yield into market price. Multiple names can be used and we have used this term dividend rate, dividend yield when I did mutual funds also. Second part, return on equity. There are different names for this. You can call return on equity. You can call it as IRR. You can call it as rate of return on investment. You can call it as rate of return on retained earnings. You can call it as return of the company. Different names are there. How will you calculate? EAES divided by equity, or EAES if you divide by number of shares is called EPS. Equity if you divide by number of shares is called book value per share. So you can calculate ROE using this formula, which is EPS divided by BVPS. Third part is called earnings per share. What is earnings per share? We have done so many times. EAES divided by number of equity. What is EAES? PAT minus, we have not done preference dividend, but preference dividend may come in few questions. PAT minus preference dividend divided by number of share. Once you get this number, that is called earnings per share, or you can use this formula also, ROE into BVPS. Where is this formula coming from? ROE is equal to EPS multiply BVPS. What is KE? What do you want? What do you want? There are other names for it. What is your required return? What is your opportunity cost of capital? Or what is rate of capitalization of the company? Our cost of capital can be cost of equity if it's a 100% equity company. Our equity capitalization rate, different names I can use. I can use different names for this term. Any doubts till this? Any doubts on this? So I have dividend, which is total dividend by number of share, or I can do EPS into payout ratio, dividend rate into face value, dividend yield into market price. All of this is learnt. Okay, it's not new. It is done at CA Inter itself. Return on equity, other names are there. IRR, rate of return on retained earnings, return on investment, EAES by equity, or EPS by BVPS. Earnings per share, you divide by the number of shares and get EPS, or multiply ROE into BVPS. Clear? Now, why are we doing this? Two numbers. One is your return on equity and cost of equity. To multiply here R by KE into E minus D. Clear? Any doubts on this? First MCQ example, you will do it along with me. EPS 10, payout 25%, cost of equity 10%, return on equity 5%. What is the price of share as per Walton model? Straightforward, simple question just to get started with. I have to calculate price of the share as per Walter's model. Write the formula. Price equal to D by KE. D by KE plus R by KE into E minus D. Both have common denominator only. Somebody will ask, can I club it together? Yes, you can club it together. Why I explained as two separate parts? To explain the logic. First part is dividend. Second part is retained earnings or future capital appreciation. Retained earnings are future capital appreciation. Microsoft for a very long time, D by KE was 0 because they were believing in R by KE into E minus D. When growth options came down, they started paying dividend. They started paying dividend. How much is the earnings here? 10. Payout is 25%. So 2.5. Cost of equity is 10%. 0.10. I normally write decimal only. 0.10. R by K is 0.05. 0.1. 10. Here that multiplier is 0.5. 0.05 by 0.10. Whatever you're retaining, no, market is giving only half value for that. Market is giving only half value for that. Reason is you are saying give me 10% and I am telling you I'll give only 5%. Now you will fight with me and say that give entire 10 rupees as dividend. Give entire 10 rupees as dividend. What is the point of retaining the money when you can't earn even 10%? That's the discussion. Point is very simple. 10 rupees is there. Either I can keep it. I am the company, or you can keep it. You are the shareholder. If I keep it, I earn 5%. If you take it, you earn 10%. Obviously, you'll take the money and go away. So here it is 25. This side 37.5. Put together. If the same company instead of 2.5 had done 10 by 0.1 plus 0, no retention, it would have been 100 rupees. It would have been 100 rupees, no retention, zero retention. Entire money take it. 10 by 0.1 would have become 100. Any doubts in this? Clear? What is the appropriate dividend payout ratio? Appropriate payout ratio depends on who can earn more money. If you can earn, what is you? KE. If you can earn, take entire money with you. If I can earn, what is I can earn? ROE. If I can earn, I will keep the entire money. Both are same. You take it, I keep it, indifferent. So if R is greater than KE, Microsoft in the initial years, zero dividend. If R is equal to KE, any amount you can pay 10, 15, 20, 25, 30, whatever percentage you pay. And R is less than KE, it's a declining scenario. It is a declining scenario. This scenario, payout 100%. Last problem which I did know, we should have paid 100%. We should have paid 100%. Clear? Any doubts on this? Practically, companies won't go to the extreme of 100, won't go to the extreme of 0 also, but this is a concept is, if you have projects, if you can put money to good use, keep it. If you cannot put money to good use, give it to the shareholder, they will put it for good use. Clear? Total earnings 1 lakh, number of equity share 1 lakh of 10 each, P multiple 8 times. The company is currently following 100% payout ratio. What should be the optimum payout? Optimum payout is comparing R and K. Comparing R and K. Nothing for you to write. When you have to write, I'll explain. What is R? EAES by amount of equity. EAES is 1 lakh. Amount of equity is 1 lakh into 10. Amount of equity is 1 lakh into 10. So my ROE is 10%. ROE is 10%. 1 lakh divided by 10 lakh. 1 lakh divided by 10 lakh. ROE is 10%. Cost of equity has a formula called 1 by P multiple. I'll explain this at some other stage. 1 by P multiple, which is 1 divided by 8. 1 divided by 8. You will understand this later at some stage. So R is 10%. I can earn 10. You are adamant on getting 12.5. You want 12.5. I can earn 10. You say don't keep any money. Give us the entire money. Give us the entire money. Able to understand the concept till this? Any doubts on this? I compare return on equity with the cost of equity. Return on equity with the cost of equity. I can earn more. I will keep the money. You can earn more. You take out the entire money. Take out the entire money. Any doubts till this? Can we proceed? Question 1. X Limited earns 10 per share. Capitalization rate and return on investment are 10 and 12%. Determine the optimum payout ratio and the price of the share at that payout. Optimum payout ratio and the price at that payout. Question has to specifically say Walter model for this. Later on you will learn new models. I'll explain them as we proceed. Let's start. For optimum dividend payout ratio, I have to compare what? R and K. You will have to write along with me. R and K. Now tell me, what is the R here? R is 12%. K, right. R is 12. K is 10. R is 12. K is 10. Optimum is how much? How much should I pay? 0%. I can earn 12. You want only 10. Optimum is 0%. I'll not pay any dividend. Optimum is 0%. Live online guys, you can also type optimum is 0%. I'm not going to pay any dividend. Now write price equal to D by KE R by KE into E minus D divided by KE. I'll be paying 0% here. I'll be paying 0% dividend. 0 by 0.1 plus 0 by 0.1 plus 0.12 by 0.1 into 10 minus 0 whole divided by 0.1. Yeah, got the answer in live online. $120. Able to understand this? Clear? Can we proceed? A question may give you a target price and ask you to calculate the payout ratio. If you want to practice that question too, which is there in the material. Okay. The next concept is limiting value. Let's understand what is limiting value. Limiting value means minimum possible value for a share. Then what is this minimum possible value? Minimum possible value means following a payout ratio which is opposite of the ideal payout ratio. Ideal 0, opposite 100. Ideal 100, opposite 0. What is limiting value? Limiting value is the minimum possible value for a share by following a payout ratio which is opposite of ideal payout ratio. Last question you did, ideal was 0%. If you had done 100% and calculated the value, that is called limiting value. Limiting value is following a payout ratio which is opposite of ideal payout. In the below example, tell me the ideal payout ratio. 20 and 15. What is ideal? Participate. 0%. Return on equity 20%. Cost of equity 15%. R is greater than KE. R is greater than KE. Ideal 0. Follow 100% payout and calculate the price. That is called limiting value. Follow 100% and calculate. 30 seconds, calculate. Follow 100% and tell me the value. 100% payout. 100% payout. Follow 100% payout. Okay, I've got the answer in live online. What's the answer? 100% payout means the first part only. EPS 10, dividend also 10. 10 divided by 0.15. Second part is not there. Second part is not there. Answer is 66.67. Any doubts on this? Clear? Now comes the important model, which is your Gordon's model, and then we will do a question where Walter and Gordon is done together. Gordon's model of valuation, technically called as growing perpetuity, best model to value an equity share. Walter is not that good. Gordon is a very good method of valuation. What did Gordon say is, I invest in a company. If I invest in a company, the KE, Gordon only gave this. KE is equal to dividend divided by the price I pay. This is my first earning. What I get back divided by what I give. What I get back, D1. What I give, price. Along with that, my value will go up. My value will go up, which is called growth rate. Which is called growth rate. He then changed this formula and said G goes to the other side. KE minus G. P naught goes to the other side. Formula became D1 divided by KE minus G. D1 divided by KE minus G. What is D1? Dividend of next year. Some discussion will still happen on that. KE already discussed. Growth rate, some discussion is needed. I'll explain as we proceed. D1 divided by KE minus G, or D0 into 1 plus the growth rate divided by KE minus D0 means today's dividend, or E1 means next year earnings. E1 is next year earning into payout ratio divided by KE minus G, or E0 into 1 plus G into the payout ratio divided by KE minus G, whichever way you want to do. Today's earnings, add growth rate, then into payout ratio. Tomorrow's earnings, directly into payout ratio. Today's dividend, add growth rate. Tomorrow's dividend, directly take it as D1. Any doubts till this? Now the main headache is, question will give a dividend figure. Is it D0 or D1? Is it D0 or D1 will be a headache in many problem. If question uses the word paid out, will pay now, paid last year, it means it is D0. It means it is D0. Will pay next year, end of current year, future year, likely to pay, that is D1. That is D1. D1 means dividend of next year. D0 means dividend of last year or technically current year. Clarity is not there in the question. Go ahead and take an assumption. Go ahead and take an assumption. Clarity there, happy about it. Clarity not there in the question, I will have to take an assumption. There will be problems where clarity will not be there. We will give two answers. One with given dividend as D1, another with given dividend as D0 and give another answer. Any doubts till this? Any doubts on this? The dividend given in the question can be D0, can be D1, paid out, will pay now, paid last year is technically D0. Practical world, what is D0 and D1 is? D0 means immediate dividend. Immediate means I buy. Next 5 days dividend will come. That's called D0. If it's going to take little bit more time, when I say more time, more than 3 months, 4 months, that is called D1. That is technically called D1. D1 means something which is going to come after 3 months or after 6 months. D0 means just paid 2 days back or getting paid or got paid in last 1 month. That is D0. What was paid earlier is called D0. What is likely to be paid after maybe some reasonable time, after a reasonable time is called D1. I am in 2025. For 2025 financial year, whatever dividend is going to be paid will be D1. I go to the end of December, maybe it can become D0 also. It all depends on when is the dividend going to be paid. This is a practical angle for you. Problem solving, clarity may not come, so we may have to take assumption. Long-term growth rate is 8%. Company is expected to pay dividend of, in my MCQ I will not have that clarity missing part, 4 per share next year. The cost of equity is 12%. What is the fair value of the share? D1 divided by KE minus G. D1 4 rupees, KE 12%, G 8%. You get the price. All our basics we have already used this when we were doing that revision in growth rate in the valuation of your M&A. Any doubts till this? Can we proceed? Next important discussion is on the growth rate. Any doubts till this? Gordon's model, it can be D1 by KE minus G, D0 into 1 plus growth rate by KE minus G, or E1 into payout ratio by KE minus G, E0 into 1 plus growth rate into payout ratio by KE minus G. As long as clarity is there on the dividend, go ahead and take that number, divide by cost of equity minus the growth rate. How is growth rate calculated? Two approaches you follow. Second approach is very rarely used by ICI. It is more of a CA inter part, not at CA final. Okay, CA final mostly the first part. The growth rate all depends on two factors. Let's take an example. I create a fixed deposit of 1 lakh. This fixed deposit will give me 10% interest. I earn 10,000. Fixed deposit will earn 10%. I get 10,000 rupees from the FD. What can I do with this interest? I can take it, or I can add it to the FD balance. What did I do is I took 4,000 for my purpose. 40% I took it. 6,000 added to the FD value. Next year, 1 lakh into 10%, 10,000. Tell me 40% of this. Balance 60%. Next year, 112,360 into 10%. How much? 11. 40% of that. 4. Next, this one. 6, 7. 4, 2. 10,000 becoming 10,600 is what growth rate? What is the growth rate if 10,000 becomes 10,600? 6%. 4,000 becoming 4240, same 6% you will get. 6,000 becoming 6360, same 6% you will get. 1 lakh becoming 1 lakh 6,000, same 6% you will get. Growth rate is 6% in this example. I'll come to the formula in some time. This is value of the company. This is total earnings. This is dividends, and this is retained earnings. Total earnings, dividend. Dividend means I took out the money. Retained earning means I added it in the company. So growth means growth in value of the company. Technically it's share price. Growth in the dividends of the company. Growth in the earnings of the company. Growth in retained earnings of the company. So growth basically means everything will go up. Dividends will go up. Earnings will go up. Retained earnings will go up. Share price will go up. Value of the company will go up. How did this 6% come? Is ROE 10% into retention 60%. I'm retaining 60% of the profits. You retain 60% on that. Whatever you're retaining, you're earning 10% on that. Whatever you're retaining, you're earning 10% on that in the next year. ROE into retention ratio. Can I increase the growth rate? Yes. Instead of 4,000, take only 2,000. Retain earnings 8,000. Next year 1 lakh 8,000. 10,800. Growth will become 8%. Growth will become 8%. The growth rate logical formula is earning ability of the company. Earning ability means ROE of the company or ROE of the fixed deposit. ROE of the fixed deposit multiplied with what am I retaining in the fixed deposit. If I retain full money, growth would have been 10% because ROE into retention is 100% retention. First formula is ROE into retention ratio. Growth rate means it's not growth rate in dividend alone. Dividends, earnings, total earnings, retained earnings are your share price, value of the company, everything will go up at the same rate, ideally at the same rate. So ROE formula EAES by amount of equity, retained earnings, retention ratio is retained earnings by total earnings. Other formula I'm not spending time on it. Later on if you want you just read through it. One example will be there. Important is this one. Important is this one. IRR of a company is 20%. IRR means earning ability of mine is 20%. I can earn 20%. Investor wants 15%. This is called KE. Dividend is 2 per share. Earnings is 5. 5 rupee earning, 2 rupee dividend. 5 rupee earning, 2 rupee dividend. What is the payout ratio? Retention ratio 40 and 60. Growth rate is 60 into IRR, ROE, ROI, rate of return on retained earnings. Different names can be there. ROE into retention ratio. ROE into retention ratio. Any doubts on this? Clear? Can we proceed? Done. I'll come back to other concepts later on. If you want to do this, the other one, you just try seeing this at home. Future value, present value logic. I don't see that very critical as of now. Let's come to question 5. Question 5. A company has a book value per share of 137.8. Return on equity is 15%. Policy of retaining 60% of its earning. Opportunity cost of capital is 18%. Compute the price of share today using dividend growth model. Growth model is Gordon's model and Walter's model. Dividend growth model and Walter's model. Calculations shall be rounded off to 2 decimals. Clear? We will start doing it. They have asked us to do the Gordon's model as well as the Walter's model. First, let's do Walter and then I come to Gordon's model. Price equal to price equal to whatever I'm doing till now is CA inter, okay? Price equal to Walter model D by KE R by KE into E minus D whole divided by KE. D by KE plus R by KE into E minus D whole divided by KE. The dividend is 40% of earning. How can I calculate earning here? Now write ROE below some gap you leave and write ROE is equal to EPS by BVPS. Leave some gap and write ROE is equal to EPS by BVPS. EPS divided by BVPS. How much is the ROE? 15%. EPS is what we are calculating. What is book value per share? Let me know the EPS number. One good part about Walter model is no headache of D0, D1, E0, E1. That headache is not there. EPS is 20.67. Dividend is what percentage of this? So do 40% and tell me the value. 2 decimal, let's keep it 8.27. 8.27. How much is cost of equity? 18, na? Cost of capital is cost of equity. Cost of capital is cost of equity, which is 18%. 18%. R is how much? What was the E we had calculated? 20 point. .27 divided by 0.18, which is 45 point plus 0.15 divided by 0.18 multiplied with what is that? 18 point, sorry, 12.4 divided by 0.18, 57 point 103 point. Clear? This is your Walters model. Clear? Any doubts on Walters model? D by KE, R by KE into E minus D whole divided by KE. Next, Gordon's model. Gordon's model, technically called dividend growth model. Both will obviously give different answer. They have their own logic of valuation. Both will give different answer. P naught is equal to D1 KE minus G. KE minus G. KE minus G. You calculated some dividend. What was that number? It is assumed. You have to write this, okay? It is assumed 8.27 is D1. Then I'll give another answer because I don't know when this dividend will be paid. Clarity is not there in this question. Two answers will give. One, we are assuming it to be D1. 8.27. What is the cost of equity? 18%. Growth is, leave a line, ROE into retention ratio. I've already got the answer in live online. ROE into retention ratio. What is ROE? 15. Retention? 0.6. Point. Any doubts on this? 91.89. Can you proceed? This is one answer. I have no clarity when this dividend will be paid. I have no clarity when this dividend will be paid. So I'll give an alternate answer. What will be there in ICA solution? I don't know, because clarity is missing in this question. Gordons will have this problem. Few places clarity will not be there. Clarity not there. Please take two assumption. Will not take us much time to do the two calculation. Alternate answer 8.27 assumed as D0. Assumed as D0. 8.27 assumed as D0. D1 KE minus G. What is the growth rate? 1 plus 0.09 divided by 18 minus 0.09. 100 point. Any doubts on this? Clear? Both the answers are logically right. It all depends on when the dividend will be paid by the organization. Clarity could be missing in the question. Any doubts on this? Can we proceed? Clear? Let's come to question 3. Following information is collected from the annual reports of J Limited. PBT, tax rate, retention ratio, number of outstanding share, equity capitalization rate, rate of return on investment. Market price in the bull market is around 28. Advise whether the share of Golden Limited should be purchased or not. How do I give advices? By calculating my fair value. I will do the valuation. How will I do the valuation? Maybe Walter's model, maybe Gordon's model, maybe some other model as you learn. Here both are possible. Walter is also possible. Gordon is also possible. They have PBT. You are going to do it. Less tax, PAT, divide by number of equity share, EPS. EPS into some payout ratio is dividend. Apply Walter. Give answer under Gordon also. Gordon to answer. Whatever dividend you got, D1. Whatever dividend you got, D0. After all these answers are done, we will compare with 28 and then give the advice. Walter as well as Gordon, both you are going to do. I will wait for 3-4 minutes. I give you that time. You start doing it. 3-4 minutes for you. So calculation is very simple. PBT 2.5 minus 40%, PAT 1.5 crores, divide by 50 lakh, EPS is 3 rupees. In that, dividend is 60%, 1.8. Walter formula 1.8 by 0.12 plus 0.15 by 0.12 into 3 minus 1.8 whole divided by 0.12. This part is 15. What's the second part value? 12.5, 27.5. Gordon's formula D1 by KE minus G. D1 by KE minus G. D1 is going to be very simple. Here the D1 is whatever you have calculated is D1 1.8. KE is 0.12. Growth rate is ROE into retention ratio. ROE is how much? 15%. Retention 40%. So growth is 0.06. 30. Another answer will be 31.8. It is around 28. 28 means if I go see different model can give different answer. Gordon is a superior method. Gordon is a superior method. So as per Gordon method, we are getting 30 and 31.8. It is available somewhere at around 28. I will go ahead and buy the share. I will go ahead and buy the share at the rate of 28. Walter is giving a different answer. Gordon is a superior method. Clear? Can we proceed? Any doubts on this? Let's come to question 7. Shares of Voyage Limited are being quoted at a price earning ratio of 8 times. Company retains 5 per share, which is 45% of its EPS. You are required to compute cost of equity to the company if market expects a growth rate of 15%. If the growth rate is 16%, calculate the indicated market price with the same cost of capital. If the cost of capital is 20, growth rate is 19, what is the market price per share? Multiple parts are there in the question. We will do it, but I will give one answer only. In the rework, we are not going to do D0, D1, too many, because three parts are there. First part of the question, cost of equity to the company with a growth rate of how much? 15%. Growth rate increases to 16%. Calculate the indicated market price. We have already done this today when there was one problem where they said growth rate is 6 and then growth rate became 8. That is what we had done that time. And technically, when I did that in the M&A chapter initially at all, whenever you see that in M&A chapter, you may find it little tricky. But when you see the same in security valuation, you feel this is normal. Same thing only ICA did. From here, they pulled it and put it in that question. Let's start doing it. K is equal to D1 by P naught plus growth rate. D1 by P naught plus growth rate. I am doing one answer only. If time permits, you can do two answers also. What is two answers? D0, D1 assumption. D1 by P naught plus growth rate. Company retains 5 per share, which is 45%. Can you tell me what will be earnings per share then? Retention is 45% of 5. Sorry, 45%, which is 5 rupees per share. Sorry? No, read it carefully. Read it carefully. Company retains 5 per share, which is 45% of its earnings per share. Retained earnings is equal to 45% of earnings per share. This is 5.45 into EPS. EPS is, I would have changed the question wordings there because there is some confusion in that word question. 5 divided by 0.45. 5 divided by 0.45. What's the number you get? 11.11. Some questions have changed the numbers to fine tune with ICI material. 11.11. 5 divided by 0.45. 11.11. Dividend is 11.11 minus 5. Dividend is 11.11 minus, which is 6.11. Price is EPS into P multiple. Price is EPS into P multiple. EPS into P multiple. I'm assuming the 6.11 is D1, okay? Somebody says D0, add growth on top of it. 6.11 divided by, what is the price today? EPS into P multiple. Price is nothing but EPS into P multiple. What is the EPS we calculated? 11.11. P multiple 88.88 plus 0.15. 21.87%. Now, I follow the same KE, but growth changes. Price will go up, go down in the market. Price will go up or go down in the market. 21.87%. Any doubts on this? Can we proceed? Any doubts on 21.87%? Clear? Revised scenario. P naught is equal to D1 KE minus G. D1 is 6.11. K is 2187. Growth is 0.16. $6.11 divided by 5.87%, you get 104.09. There can be rework done for all the scenarios, which is taking it as D0. It will be a time consuming one. It will be a time consuming one. 104.09. Clear? Can you proceed? Third scenario, P naught is equal to D1 by K minus D 6.11. What is the K number they have given? 0.20, 0.19. 20 and 19. 611. Clear? Any doubts in this? Straightforward, simple calculation. Any doubts in this? I'm not sure if I've done rework here. No, I've not done the rework. I've just done this calculation and ended it. Any doubts in this? Can we proceed? Done. Now, I'll discuss the other one also, because one concept has to be discussed with this. Another way of calculating growth rate is looking at the dividend history. What is looking at the dividend history is, you give me last 10-year dividend. So what I understood is, dividend was 10 rupees. You kept on increasing it, became 20 rupees. In how many years? In 10 years. Earlier value is called present value, later value is called future value. Whenever, if you are in 2000, 2000 is present, 2010 is future. If you are in 2010, 2010 is present, 2020 is future. Whatever date, the earlier value is called present value, the later value is called future value. So I had dividend history. 10 rupees is called present value, 20 rupees is called future value. We have an approach called future value is equal to present value into R power n. 20 is equal to 10 into 1 plus R power 10. What is that R you have to calculate? That is called growth rate. You will not be able to do in calculator. In Excel I can do it. That's why I didn't want to discuss it. 1 plus R power 10. This is one way of calculating growth rate. Looking at the past history. Looking at the past history, I can calculate the growth rate. Take the first dividend as present value, last dividend as future value, and you can use either future value factor or present value factor. Clear? Any doubts on this? There is one MCQ you can do later at home. Now, when I follow this approach, one scenario which can happen, a rare scenario can happen is, data could be given for EPS as well as DPS. The data could be given for earnings per share or dividend per share. Past history. Whenever they give you both, ideal scenario is to calculate growth rate using EPS. Why? Because EPS reflects the real growth rate of the company. Why DPS does not reflect? DPS can be changed by us by increasing payout, decreasing payout, increasing payout, decreasing. I can alter dividend, but I can never alter earnings. So earnings reflect the real growth of the company. If at all you use past data, not very critical concept, but if you are using past data, earnings growth rate is the real reflector of the growth, and not dividends is the real reflector. Clear? How will you do? Take the past information, one last dividend, whichever year you have, that is first dividend which was there, present value, and the last dividend which is just a year back, that is called future value, and then do the calculation. Any doubts on this? Not a very critical concept. CA Inter, it is tested in 5-6 question. CA Final, I don't expect them to test it. Clear? How to compute return on equity? We have already done it at few places. Anyway, still I'll discuss. EAES divided by amount of equity. What is amount of equity? Share capital plus reserves and surplus minus the fictitious asset. If you divide that by number of share, you get BVPS. EPS by BVPS. Let me see if you are able to do this. A little tricky example. Question 15. Get me the ROE. Question 15. Get me the ROE. 1 minute for you. Little tricky example. Not okay. It'll take time. Not very tricky, but take time. 1 minute for you to solve this. No, no, friends, example 15, 15, not 14. Okay, I've got started answer in live online. Example 15, the below one. Okay, 15th example. You need to do some calculations and then get to the answer. ROE formula is EAES by equity. Tell me the EAES number first, which is your 10 lakh minus 50% 5 lakh minus preference dividend, which is now 4 lakh. Equity share capital plus reserves and surplus minus fictitious asset. Share capital is 5 lakh, reserves and surplus 45 lakh minus fictitious asset 10 lakh. Denominator is 40 lakh, 10%. Any doubts on this? Any doubts on this? Clear? Can we proceed? Any doubts on this? This is on return on equity. Whatever I'm discussing will become the base for many models which we are going to do. Major problem solving may not happen in today's session. Major chunk will be on the concepts, getting the grip on the base. Technically CA inter. I'm just doing CA inter till now. Any doubts on this? Cost of equity. What is cost of equity? Is what does a shareholder want? How will I calculate cost of equity? First is, if you are a dividend paying company, Gordon's formula. What is Gordon's formula? K is equal to D1 by P naught plus growth rate. At inter, you would have learnt that if at all any flotation cost is there, P naught minus F we do. F is flotation cost applicable in case you make any new issue. If there is no new issue made, that is not applicable. Self-explanatory formula. Another formula is capital asset pricing model. What does capital asset pricing model say? RF plus beta into RM minus RF. 100% you will have clarity on this, but anyway, portfolio management, we will discuss this again. If you are a non-dividend paying company, example, Microsoft for a very long period was non-dividend paying company. I will do RF plus beta into RM minus RF. Another formula which I had used in some other question, I said 1 by P multiple. Let me explain the logic. What is the formula for P multiple? Tell me the formula for P multiple. MPS, EPS. Inverse is EPS, MPS. K is equal to D1 by P naught plus growth rate. If EPS is fully paid as dividend, because I have written a note, useful if there is a 100% payout. Rare scenario, even if there is no 100% payout, we may use this formula, but most of the time 100% payout has to be there. So EPS is equal to D1, MPS is equal to P naught, growth will not be there, 100% payout. 100%. So that 1 by P is not a new formula. 1 by P is that D1 by P naught plus growth rate. D1 means E1. P naught means price. Growth is anyway not there. Growth is anyway not there. So not a new formula. It is this formula only. It is this formula. Inverse of P multiple. P multiple is MPS by EPS. EPS divided by MPS. Any doubts on this? Clear? Can we proceed? Give me answer to 16. Already got the answers in live online. In the MCQ, that headache will not be there. D0, D1. I would have drafted it that way. When you do a problem, the critical part is not the KE calculation. The critical part is understanding it is KE, because now you will know. But when I discuss it as a part of a bigger problem, suddenly you find it little difficult to grasp. What rate of return does an investor expect is called investor required return. Technically KE. Technically KE. What investor wants is called cost of equity. Calculation is not very critical. D1 by P naught plus growth rate, that's very simple. But what is asked in the question is KE, because when you do it as a part of a bigger problem, so many information will be there. Some student will say they're asking ROE. No, they're not asking ROE. They're asking KE. Investor, what he wants is called cost of equity. Clear? Any doubts on this? Give me answer to 18. 18th example. Started getting the answers here. 6 plus 1.5 into 8 as it is. Risk premium of market means RM minus RF. Risk premium of market means what extra market wants. Market return means RM. Risk premium of market means RM minus RF given directly to us. Any doubts on this? Clear? Can we proceed? Any doubts on this? Done. I'll come back to some of this project, some of these concepts as we proceed. Let's come to 8. Let's come to 8. SAM Limited has just paid a dividend of 2 per share, expected to grow at 6% per annum. After paying dividend, board declared to take up a project by retaining the next 3 annual dividend. It's expected that this project is of same risk class as the existing project. Result of this project will start coming from the 4th year onwards. The dividend will then be 2.5, grow at 7%. Investor has 1000 shares in SAM Limited, wants a receipt of at least 2000 per annum from this investment. Show how the market value is affected by the decision. Also show how an investor can maintain his target receipt from the investment for first 3 years and improved income thereafter, given that cost of capital of the firm is 8%. You go through it and then I'll start explaining. Go through the question. Okay, I'll explain the question, discuss 2 concepts around it, and then we solve this question. I think with that we may end the session. Let's first understand. SAM Limited just paid a dividend. Just paid a dividend means D0. Expected to grow at 6% per annum. After paying dividend, board took up a project by retaining the next 3 annual dividend. It's expected that this project is of same risk. Same risk means KE will not change. You do any new project, KE can go up, KE can go down. If risk increases, KE will go up. Risk decreases, KE will go down. Result of this project will start coming from the 4th year onwards. The dividend will then be 2.5, grow at the rate of 7% per annum. Investor is having 1000 shares in the company and he wants a receipt of at least 2000. So I have invested in this company with the hope that I will be getting how much? 2000 per annum from this investment. Suddenly the company says we will stop paying dividend, but I need 2000 rupees. I need 2000 rupees. 2 things they have asked us to calculate. One, what is the impact on the share price? Second thing, how can I maintain my income? Because I want 2000 rupees from the company. Company clearly told me we are not going to pay dividend. Now, 2 concepts we need to be aware. How do I maintain dividend income when a company is not ready to pay dividend? When a company is not ready to pay dividend, very simple. Company pays dividend, dividend income meets commitment. What is commitment? I am a person who wants regular income from the share for meeting my day-to-day expenses, whatever requirements I have. I had invested in such companies which will regularly pay dividend. Company stops paying dividend, do partial sale of share till the company starts paying dividend again. So I started with some 1000 shares in that example. I will sell some 10 share, 15 share, 20 share, 23 share. So whatever number I decide, I will sell it. Which year? They are talking about 3 years. So in the problem which we are doing, I need to know today's price. I also need to know what will be the price at the end of first year. Why at the end of first year? I have to sell shares. I also need to know what is the price at the end of second year because I have to sell share. I also need to know what is the price at the end of third year. Again, I have to sell the share. So I have to calculate so many prices because I am going to sell shares. I am going to sell shares. Today's share valuation P0 we can calculate, but P1, P2, P3, how do I calculate? So there are certain ways to do it. I'll explain. So here there are people who do dividend investing. Dividend investing means you are going to get regular income. You can do this example at home later on. The problem which I am going to do is going to more or less discuss this example. Okay, this is one part. Second part is computation of price of different years. You would have learnt an approach called Modigliani-Miller approach at CA Inter. I'll explain the logic of that approach and then I'll tell you, is this only for equity? No, it is for land, building, plant, machinery. Anything can be valued using this logic. P0 means today's price, but you don't want only today. You want first year, second year, third year, fourth, fifth, sixth, seventh. Now what Modigliani-Miller said is, Microsoft today is 100 rupees. I want 12% return from Microsoft. So at the end of the year, it has to become 112. Microsoft said, I'll give you 1 rupee dividend. Then give me price 111. I want 112. My logic is very simple. 100 should go up by 12%. So by end of the year, can you give me 112? How can I get 112? Dividend 1 rupee, price 111. Dividend 2 rupees, price 110. Dividend 3 rupees, price 109. Dividend 14 rupees, price 98. Dividend 20 rupees, I want 112 at the end of the year. I want 112 at the end of the year. So he said, price at the end of the year. Today price. Add 1 plus KE. What is 1 plus KE? What you want? 100. Add extra 12%. Add extra 12%. 112 I want. 112 I want. Then company says, I will give you dividend of 4 rupees. Price can go down. Dividend of 6 rupees. Price can go down. This is P1. P2 is equal to P1 into 1 plus KE. Second year dividend. P3. Is this only for share? No. Value of property in first year. Value of property today into 1 plus KE are my required return minus rent of first year. It will not give dividend, it will give rent minus rent of first year. Value of property of second year, property value first year into 1 plus KE minus rent of second year, minus rent of second year. Any income generating asset, I want 14% return. If you are generating regular income, price need not go up 14%. Price can go up lesser. Clear? Able to understand this? You want to do in debt valuation. Value of bond at the end of year 1 is equal to year 0 value into 1 plus KD minus interest of year 1. Minus interest of year 1. Any asset you can value using this logic. Year 0 to year 1 you can move. Year 1 to year 2 you can move. Year 2 to year 3. Year 3 to year 2. Year 2 to year 4. Any years you can move forward. Clear? This formula you should understand with full grip. And this is a very good example. You will do this at home later on. Okay. At home you will do. Price is given in third year. From third year you have to come to second year. How will you come to second year? P3 is equal to P2 into 1 plus KE minus D3. Very good example. You do this at home. Okay. From P3 you will come to P2. From P2 you will come to P1. From P1 you will come to P0. All this calculation you do at home. Now I come back to the question which is being discussed. Is this only for equity valuation? No. This is for bond, equity, any asset valuation. Even a property can be valued using this logic. Clear? Able to understand till this? Can we proceed? Understand some of the concepts very clearly. Practical world has a lot of utility of all of this. Now coming to this question. Company just paid dividend of 10 rupees and is growing at 6%. let me value the company today without the project. Then I'll value the company with the project. There can be a difference. That difference is the market value of the share affected by the decision of the board. By the decision of the board. Board is taking some decision, value can change because of that. Then how can I maintain the income? I need price of year 0, which is today's price. Anyway, we will calculate price of first year, price of second year, price of third year. I will calculate price for different years. With that, 2000 rupees I want. 2000 divided by price of every year will tell me how many shares are to be sold. Very simple concept, but lot of good things are tested. Today price P naught is equal to D1 by K minus D, assuming you continue to pay dividend. Why you continue to pay dividend? Without project, you will pay dividend. With the project, you will stop paying dividend. So now write P naught is equal to price before project. Price before project. P naught is equal to D1 K minus G. D1 by K minus G. What is the dividend paid earlier? What is the growth rate? 6%. 2.12. Cost of equity 8%. Growth 6%. 106. Good. That's the value today. I am going to do a project. Moment you do a project, A can change also, but it's not changing. Growth is changing, but there's one problem. After paying dividend, board has decided to take up a project by retaining the next 3 annual dividend. I told P naught equal to D1 by K minus G. I asked you D1, you are saying 0 because they are not going to pay dividend. Once you do the project, first year no dividend, second year no dividend, third year no dividend. Gordon cannot be used till you pay dividend. First year no dividend, second year no dividend, third year no dividend. It's expected that the result of this project will coming from which year? Fourth year. Dividend will then be how much? 2.5 and will grow at what rate? 7%. So listen, like P naught is there, I can do P3. P3 means price of third year is equal to dividend of fourth year. P3 D4, P naught D1, P1 D2, P2 D3, P3 D4, D4 by K minus G. Price after project. Price after project. P3 is equal to D4 by K minus G. First you get this, then I'll tell how will we come to P0. P3 is equal to D4 by K minus G. What is the fourth year dividend? The question is saying 2.5. No change in cost of equity or cost of capital. 8% growth. And it's very crystal clear, 2.5 in the fourth year and then grow at 7%. Okay, if it was 2.5 and it has to have a growth, then I'll have to add the growth rate also. 2.5 in the fourth year. I have P3. From P3 I can come to P0 directly also, but I don't want to do that. I will use Modigliani-Miller. P3 to P2, P2 to P1, P1 to P0. Any doubts till this? Now write P3 is equal to P2 into 1 plus cost of equity minus dividend of third year. P3 is equal to P2 into 1 plus cost of equity minus the dividend of third year. Dividend is not there, so in my solution I would have just directly divided by cost of equity, but okay. P3 is equal to P2 into 1 plus cost of equity. Logic, understand formula. P2 I have a price. That price has to increase at the rate of cost of equity at least. And if you are paying dividend, it can go down little bit. 250 is equal to, what is the cost of equity? 1 plus 0.08. Any dividend in the third year? No. In that MCQ which you do at home, no, dividend is there in the third year, dividend is there in the second year, dividend is there in the, that's a very tricky one. So at home, practice it, you will get grip on the concept. Calculation is not very tricky, but at home, practice that question. Calculate and tell me what is P2 now. Any doubts on this? Repeat. P2 is equal to P1 into 1 plus KE minus dividend of second year. Minus dividend of second year. This is Modigliani-Miller formula. Logic is very clear. The formula logic is what you need to be aware of. Other things and all, if you try to do, it will not. Forward working, when you do, it will be easy to understand. Reverse working becomes little challenging to understand. What is P2? 231.48. P1 into 1 plus minus 0. P1 is clear. Okay, then I come to P0. P1 is equal to P0 into 1 plus KE minus D1. 214.33, 1 plus 0.08, project will increase the share price from 106 to 198. It's a very good project. 106 will become 198 as per the model of valuation. As per the model of valuation, it has to become what? 198.4. Any doubts till this? Understood the first part of the calculation? And why did I do every year calculation? For the next part. The second part you need not do. I'll discuss it. Okay. How will the investor maintain his target receipt for first 3 years and improved income thereafter? How much the investor wants? 2000. First year. Tell me what is the first year price? 2000 divided by 198.45. I will sell. Sorry, first year, not year 0. I'm asking first year price. Today I'm not going to sell anything. 214.33. 2000 divided by 214.33, you get how much? 9.33 rounded off to 10. I will not round off to 9. If I round off to 9, I will not get 2000 rupees. I need minimum 2000 rupees. I'll explain again. 2000 divided by 214.33. If you sell 9 share, you will not get 2000 rupees. So you will round it off to 10, sell it. Like this, we will keep selling shares. I sell 9.33 rounded off to 10. I sell 8.64 rounded off to 9. I sell 8 share. After everything is over, I'll be still having this many shares. And my income will be then this many share into 2.5. This many shares into 2.5. I will be having 1000 minus 10 minus 9 minus 8 multiplied with 2.5. Able to understand this? It's a good question. May not get repeated and all in exam, but it's a good problem. Any doubts on this? Any doubts on the concept? Understood this? I'll repeat whatever concepts we have done today in this area, and what I want you to 100% do is this part. I'll tell you the concept number. Before the next session, you have to do for concept 28 at home, 28 at home and 29 at home, 28 and 29 along with MCQ. In class, when I discuss, first I may not discuss, and even if I'm discussing, the pace will be very, very fast, because discussing every ratio is a time consuming exercise. I will not have the time to discuss everything. But if you go through this properly, understand this properly, it will be good. You need more clarity. My CA Inter videos are there in my YouTube channel, but I don't think you will feel the need for it. You go through it, you will get clarity. But 100% go through this with all the examples. Some 6-7 examples are there, 28 and 29 before the next session. Today's class revision. We started with time value of money. Time value of money had few concepts. Future value, which is today's value into 1 plus r power n. Present value, tomorrow's value divided by 1 plus r power n. Annuity means multiply with future value annuity factor or present value annuity factor. And perpetuity means use the Gordon's formula. Gordon's formula is CF1 by KE minus G. Walter said for valuation, two parts are there. What is paid, what is not paid. Paid is D by KE, not paid is R by KE into E minus D divided by KE. R by KE is like a multiplier. If R is greater than KE, you will multiply, magnify by more than one time. If it's R is less than KE, value will depress to less than one time. D means dividend per share, EPS into payout ratio, total dividend by number of equity share into face value, dividend yield means into the market price. Return on equity, IRR, other names are there. How will you calculate ROE? EAES divided by amount of equity, EPS by BBPS. E is earnings per share, total earnings by number of share, or ROE into BBPS. KE cost of equity, investor required return, opportunity cost of capital, different names are there for KE. What is appropriate dividend payout ratio? Comparing R and KE. R greater than KE, growing company. R equal to KE, normal company. R less than KE, declining company. Growing company, no dividend paid out. Declining company, 100% dividend paid out. Limiting value following a payout ratio which is opposite of the ideal payout ratio or the optimum payout ratio. How is value determined under Gordon's model? D1 by K minus D, D0 into 1 plus D divided by K minus D, E1 into payout ratio divided by K minus G. Dividend given can be D0, can be D1. Clarity there. What is clarity there? Paid out, will pay now, will has already paid. All this is D0. Will pay in future. Next year it will pay D1. No clarity, take assumption. How will you calculate growth rate? Based on earning ability, ROE into retention ratio, or based on past dividend, are technically past EPS history. EPS is better rather than dividend. So based on dividend history, first dividend, last dividend, face, present value, future value. Example 13, just see at home, okay? How will I calculate return on equity? EAES by amount of equity, or EPS divided by BBPS, and this can also help me in calculating the earnings per share if needed. Cost of equity, what does an investor want? D1 by P naught minus F plus growth rate, RF plus beta into RM minus RF, or inverse of P multiple, inverse of P multiple. Computation of price for different years, today's price into 1 plus KE minus the dividend paid is next year price. P1 is equal to P naught into 1 plus KE minus D1. An excellent example, question 20, just do at home, okay? Some examples only. Problem solving descriptive you do or not do, but MCQs I want you to have grip as of now. P2 is equal to P1 into 1 plus KE minus D2. And maintenance of dividend income, if you are doing dividend investing, if company is not paying dividend, I will earn my own dividend by doing partial sale of share. Clear? This is what we have done in today's session. We'll continue it in the next class. I'll end with this. Good morning, friends. Okay, let's continue with the discussion. We were doing security valuation. I'll quickly summarize the concepts done in the previous session. We started with something called as equity valuation. In that, the first approach we saw was Walter's model, which said that price is a combination of two items. One is what you paid today, which is dividend by cost of equity, and what you are likely to pay in future, which is R by KE into the retained portion E minus D divided by KE. Now, D represents dividend per share computed as total dividend by number of share, EPS into payout ratio, face value into dividend rate, or market price into dividend yield. R is return on equity. Other names are IRR, rate of return on retained earnings, return on investment, return on asset. Different names can be there. EAES by amount of equity. E represents earnings per share, which is your total earnings divided by, that is EAES divided by number of equity share. You can also calculate it as ROE into book value per share. KE represents cost of equity, or what does an investor want? Opportunity cost of capital, rate of capitalization, cost of capital. Different names can be used here. An optimum payout ratios depend on two items: who can earn more. If investor can earn more, which is called KE, or can I earn more, which is called return on equity. If R is greater than KE, in that scenario, I will keep the entire money, zero dividend payout. R is less than KE, you will take out the entire money, in which case the payout will be 100%. Both are equal, we are kind of indifferent on the dividend payout ratio. Limiting value represents the minimum possible value for a share, which is computed by following a payout ratio, which is opposite of the optimum payout ratio. How do I value the share under Gordon's model? Gordon's model, we end up doing D1 by KE minus G, or D0 into 1 plus G divided by KE minus G, or E1 into payout ratio divided by KE minus G. The confusion will come, what is D0, what is D1? If it is paid in now or paid in the previous year, then it is D0. Will be paid in future, will be paid at the end of next year, that is called D1. No clarity is there, assumption needs to be taken. How do I compute growth rate? Growth rate is ROE into retention ratio. ROE is your EAES by amount of equity. Retention ratio is retained earnings divided by total earnings, or 100% minus payout ratio. Multiply both, you will be able to get the growth rate. Or you can go through the historical information. The earliest dividend which was paid and the latest dividend which is paid, you compare them and call it as future value is equal to present value into 1 plus r the whole power n, that is technically called future value factor, or divide by 1 plus r power n, which is called present value factor. Either the FVF would be given or PVF would be given, and this data ideally should be on the basis of EPS rather than on the basis of dividend per share. How do I calculate return on equity? EAES by amount of equity, or EPS divided by book value per share, and book value per share was share capital, reserves and surplus, fictitious asset divided by number of equity share. Cost of equity represents what do investor want or what do you guys want. D1 by K, sorry, D1 by P naught plus growth rate. But in case I'm making a new issue, it will become P naught minus F. Minus F is flotation cost. If you are a non-dividend paying company, RF plus beta into RM minus RF, and you can also go through a P multiple approach, which is technically 1 by P. What is 1 by P is? Your P is MPS by EPS. This is EPS by MPS. Logic is EPS is equal to dividend per share divided by the price, zero growth scenario because 100% payout is happening. Let's keep doing a few more concepts and then I come to question. Impact of a new project on a share price. Now, in the practical world, the share price changes because of multiple factors. One major factor which will change the share price is if I'm doing any new project and the new project gives me positive NPV. If a project is done and the project can generate positive NPV, it will increase the share price by NPV per share. Whatever is the NPV per share will be the improvement in the share price. Many a times, TCS is acquiring some company. Share price will start going up on the date of information or will go down on the date of information if people feel it the acquisition is positive NPV. Whenever you acquire a company, what is acquisition? When I acquire a company, I have to pay something on day zero. I will be earning something out of that company over the next 10 years, 15 years, 20 years, 5 years, and then I may sell that company. So it is a capital budgeting exercise. So whenever an acquisition is done or whenever a big project is done, if it is a favorable NPV project, share price will increase by NPV per share. And if it's a negative NPV project, share price will decrease by NPV per share. This is what will happen to the share price. What practically happens is today I have existing shares into some existing prices there. On top of it, an organization may make a new issue also. If you make a new issue in the numerator, this is like that mutual fund. In mutual fund, you would have seen we had existing net assets. Then if I make any new issue, new people are coming into the company, new shares. Ideally, the new price and existing price should ideally be same, whatever is the price, plus any NPV if the project can generate. I'm raising money and putting it in some good project. It will generate NPV for me. Add the NPV in the numerator. What is the impact of NPV is any positive NPV will increase my wealth, will increase the wealth of the shareholder, and any negative NPV will decrease the wealth of the shareholder. A small example. EPS 100% payout. Moment you see 100% payout, KE can be computed as 1 by P multiple. KE can be computed as 1 by P multiple, or EPS is equal to dividend per share. EPS is 10, MPS is 100, number of shares is 1 lakh. Company is fully equity financed. A fully equity financed company means KE and KO is same. Fully equity finance means KE and KO is same. Company wants to do a project of 1 crore at the end of year 1. I want to do a project of 1 crore at the end of year 1. It will generate 21 lakhs from year 2 onwards. 21 lakhs from year 2 onwards. What is the new share price? What is the new share price? Now, I have to first calculate NPV of this project. How do we do NPV calculations? You would have done year, cash flow, PVF, DCF. What is the project's cash flow? Discounted at WACC, weighted average cost of capital, or technically at cost of equity in this question. Discounted at cost of equity in this question. Why cost of equity? 100% equity financed. Clear? I don't want you to write anything, but it's a very good example. Understand this. KE is equal to D1 by P naught plus growth rate, or you can say inverse of P multiple. Both are same here. What is the dividend the company is going to pay here? 10, which is a 100% payout. 100% payout means no growth, no D0, D1 headache. There's no D0, D1 headache. Whatever is this EPS, that is D0, D1, D2, D3, D4. That headache doesn't come. So 10. What is the price today? 100. Growth is 0. So cost of equity is 10%. KE, KO. KER, KO. Both are same. Today the share price is 100 rupees. It will go up or come down by the amount of NPV per share. Go up or come down by the amount of NPV per share. Positive NPV, share price will go up. Negative NPV, share price will go down. Now the project which we are doing, year, cash flow, PVF at 10%, DCF. Year 1, I am spending 1 crore on a project. Year 0, I'm not spending. I'm not spending today, but I'm spending in the first year. First year, company wants to do a project of 1 crore at the end of year 1. So I spend 1 crore at the end of year 1. Second year onwards, I will generate 21 lakhs. So second year, 21. Third year, 21. Fourth year, 21. Fifth year, 21. There's no end to it. There's no end to it. I'll come to a perpetuity part in a minute. But this is the cash flow structure. Year, cash flow, PVF at 10%, DCF. Year 0, this is a very important concept. I'm going very slow. There are reasons to do this. 1 crore. A place where students keep making mistake. Year 0, 1 crore. Second year, 21 lakh. Third year, 21 lakh. This, there's no end to this, okay? There's no end to this. In Excel, I can write it any number of years, okay? I'm just writing randomly. I've written some 227 years. In Excel, I can keep doing it for any number of years. So 21 lakh like this, it's happening. I have to discount this at 10%. 1 divided by 1.1. I'm not doing any rounding off in Excel. Clear? I've written it for so many years. DCF I calculate. And I do the NPV number. NPV is coming out to be 1 crore rupees is the NPV. Okay. Obviously, in your notebook, you cannot do 220 years, 200 years and all is not possible. So, this year 2, understand this very clearly because I have tried explaining many times, student make a mistake. 2 to infinity. From year 2 to infinity, we are going to earn. Whenever you value a perpetuity, value 1 is equal to cash flow 2. Value 1 is equal to cash flow 2 divided by KE minus G, which is 21 lakh divided by 10%, KE or KO, whatever name you want to call, minus 0. Answer is 2 crore 10 lakh. The biggest point is this will be written as year 1. Cash flow comes in the second year, but the value for that will be written in the first year. Cash flow comes in the second year, value for that will be written in the first year. Many students make a mistake here. Perpetuity is always valued a year in advance. Is always valued a year in advance. Value 1 is CF2. Whenever you value perpetuity, if you are using third year cash flow to value a perpetuity, that is value 2. Your students in their mind imagine that cash flow is coming from the second year. Why is this guy writing it in the first year? Because reason is perpetuity valuation always happen a year in advance. Reason is Gordon's formula. When you do P naught, you are okay to use D1, that time no confusion. But when I tell suddenly to value it in your NPV calculation, you end up making mistake there. When I tell you to value a share, nobody makes a mistake. I have not seen a student making a mistake in P naught. D1 perfectly you write. If I ask P6, D7 perfectly you will write. But when NPV is to be calculated, your mind forces you to think that, okay, first year cash flow or second year cash flow, let us write it as year 2. Where does that make a difference? Because year 2 means second year PVF. Year 1 means first year PVF. And automatically that will lead to difference in answer. I have shown you detailed calculation in Excel. This is 0.909. Again, this also 0.909. When you multiply and get a final answer, you will get 1 crore. Okay, rounding off up and down difference can be there. Final answer will be 1 crore. Perpetuity is always valued a year in advance. If you have attended my regular class, I would have told this line 50 times in the class. Students still makes mistake, and you will also be still making mistake in sessions when I keep doing, because suddenly I'll be doing a perpetuity valuation, business valuation, and then you will again end up making a mistake. Now I can only explain it multiple times. Beyond a point, you will have to pick it up. Clear? Any doubts on this? Perpetuity is always valued a year in advance. So the project is going to generate NPV of 1 crore. If it is going to generate 1 crore NPV, 1 crore by 1 lakh, 100 rupees will be the increase in share price. 1 crore by 1 lakh, 100 rupees will be the increase in share price. Perpetuity is always valued, because here perpetual cash flow is received from year 2, valued a year in advance, year 1. This is return. But when you do, you will write this as year 2 and then do the calculation. You will end up getting a wrong answer. Clear? Able to understand this? Any doubts on this? This concept will get tested at few places. I may not immediately test it now in a problem, but it will get tested at few places. Can we proceed? Done? Okay. Undervalued versus overvalued security. This is very simple. What is undervalued versus overvalued securities? There will be an actual market price given in the question, and we are required to calculate fair market price. What is fair market price? Either under Walter's model, or under Gordon's model, or under FCFE model. Multiple models are there. You do your valuation and the market gives a valuation. A share is said to be undervalued if I feel it is 500 rupees, market is at 400 rupees, buy that undervalued security. Buy an undervalued security, sell an overvalued security. If market is giving a very high valuation, today people are talking about Lenskart being overvalued. The valuation given is overvalued. That is why people are saying not to buy it. If it's undervalued, people will say go ahead and buy that company. So undervalued and overvalued is done by comparing actual market price with fair market price. Fair market price is a tricky point. Tricky point is your way of valuation could be different. My way of valuation can be different. I will have different assumption. You will have different assumption. AMP is same for everyone. FMP is going to be different, because if everybody thinks alike, no stock market buying and selling can happen. If everybody thinks Lenskart will go up, then there will not be any person who is selling the share of Lenskart. How will buying and selling happen? So in the market, there are 1 crore investors, 2 crore investor, and different people think differently. That is where a stock market buying and selling happens. Any doubts in this? Undervalued, overvalued. I wanted you to do this question. I hope you would have done this. It was a good example to test your understanding. Uh, Let me now get to some questions and then I come back. Let's come to question 9. ABC Limited has been maintaining a growth rate of 10% in dividend. Company has paid a dividend of 3 per share. Rate of return on market portfolio is 12%. Risk-free rate is 8%. Beta coefficient is 1.5. You are required to calculate the expected rate of return as per the CAPM model and equilibrium price per share by dividend growth model. Now, it is a fairly simple, straightforward question. Many times ICI test this question. Before I start solving it, let me set the context a little bit more. This question links your portfolio chapter as well as your security valuation chapter. In your study material, same question, similar numbers is there in portfolio chapter as well as it is there in your security valuation chapter. What we are going to do here is beta would be given in the question. Using the beta, we will calculate KE, and using the KE, we will value the share. If I want to complicate this question, I will give you information to calculate beta. How will you calculate beta? You will understand in portfolio chapter. There is a formula 1, formula 2, formula 3. So beta is to be calculated and then this has to be solved. So let's come to this. ABC has been maintaining a growth rate of 10%. Company has paid dividend. Has paid dividend means D0, D1. D0. Rate of return on market portfolio 12%. Risk-free rate is 8%. Beta coefficient is 1.5. Now write K is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. What is the RF number? 8%. Beta 1.5. RM 12%. RF 8%. This will give you the KE number. K is 14%. A fairly simple, straightforward question. Nothing much is there, just to get started with. 14%. Once this is calculated, P naught is equal to D1 by KE minus G. Confusion not there? Great. If confusion is there in the question, assumption will be needed. What is confusion? D0, D1. D0, D1. Dividend paid is how much? 3. Growth rate? 10%. So 3.3. 3.3. 3 plus 10%. 3 plus 10% divided by 14 minus 10%. Your wish, you want to write. I normally prefer decimal, but sometimes I write percentage also. You need to take care of the numbers, okay? Answer I've got in live online 82.5. Next, a company pays a dividend of 2 per share. We are not going to do it. Okay, 2 per share with a growth rate of 7%. Risk-free rate is 9%. Market rate of return is 13%. Company has a beta factor of 1.5. Due to the decision of a finance manager, beta will increase to 1.75. Find out the present as well as the likely value after the decision. I don't want you to do. If I want you to do, I'll tell you. This two, what should I do? D0, D1. Ideally should be D0. Pays a dividend. Pays a dividend should ideally be D0. So my calculation will be 2.14. I don't want you to do. If I want you to do, I'll tell you 2.14. Two answers. What are two answers? One with a beta of 1.5. Another with a beta of 1.75. If beta is 1.5, tell me what is the KE? 1.5 beta, what is the KE? It can't be 13. 1.5, it has to be more than 13. RF plus beta into RM minus RF. 9 plus 1.5 into 4. Yeah, I've got answer in live online. 1.5 into 4. 15% minus 7%, and if it becomes 1.75, you will have a different KE and you will do the calculation. Clear? I don't want you to do. I'll tell you when I want you to do a question. This is okay. Yeah, let's discuss this. An investor is holding 5,000 shares of X Limited. Current year dividend rate is 3 per share. Market price of the share is 40 each. Investor is concerned about several factors which are likely to change during the next financial year. Dividend paid slash anticipated per share, risk free rate, market risk premium, beta, growth rate. In view of the above, advise whether investor should buy, hold or sell the share. Again, I'm not giving you time to read because nothing much is there. Almost similar question. Listen. What is the share price today? 40. Now they are saying today these are expectation, and because of maybe economy and other reason, the factors are going to change. Should the investor buy, hold or sell the share? My advice ideally should be based on future expectation. That is based on what I see in the changed scenario. There is an original scenario, there's a change scenario. What ICI does is they will calculate both the prices, one as per the original scenario. Does it have any utility in decision making? Ideally, no. Because what is happening in the past of Maruti, I'm not interested in knowing. Tell me future of Maruti, that is what my interest level is. They are saying investor is concerned which are likely to change. So what is likely to change should influence my decision. What is happening in now or already happened should not influence my decision. But still, we will give two answers. One based on current year number, one based on next year number. Current year number and next year number. One advice, so let's first calculate the numbers and then I give the advice. Let's start current year. Let's do current year. Current year. K is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. What is the RF number today? One participation, guys. 12%. Beta 1.3. RM directly they are given risk premium, which is how much? 5%. All put together 18.5. Any doubts on this? P naught is equal to D1 KE minus G. D1 by KE minus G. Dividend is 3 per share. Dividend paid 3 per share. What is the growth rate? So 3.27. 3 plus 9%. 3.27 divided by 18.5 minus 9. 34.42. This 34.42 will ideally not affect my decision making, but still we have done with 34.42. Any doubts on this? Any doubts on 34.42? Okay. Then they have said next year certain expectations are given. Now listen, just give me a minute. When I do my next year calculation, first I'll do the KE calculation. Once the KE is computed, I'll come to price where I'll explain something. Quickly tell me the KE number for next year. 15 point. What is the RF? 10. Okay, RF is 10. Beta 1.4. RM D1 by KE minus G. What is D1? 2.5. Now listen, you're right in every possible way to think about. Next year they've given 2.5. You want to take it as D1. What ICI does, which I don't know, right, wrong, I don't want to debate on it, but they have done it consistently. The only thing is they have done consistently. This type of a question has come few times in exam. You have to visualize as if you are in the next year. You have to visualize as if you are in the next year. So they took this as D0. They took this as D0. This is a mistake, which not a mistake, but it's a debatable issue. It's a debatable issue. You have to visualize as if you are in the next year. So if you are in the next year, this 2.5 is like D0 on top of it growth. On top of it growth. Now you may argue saying that no, this is D1. Do it. I have no problem. But I say I will not award marks because this is a study mat question. Came in May 24 exam. They did consistently this. If they do inconsistent, then I can tell you that okay, sometimes they do this, sometimes they do that. Here consistently they are doing this approach only. So you have to visualize as if you are in the next year. As if you are in the next year. So if I am in the next year, this 2.5 is D0. 2.5 is D0. If you say it is D1, is it right? Logically, you are correct. I am not saying no at all. I am not saying no at all to you, but in exam, this will not work. So 2.5 plus what is the growth rate? 7% divided by 15.6 minus 7%. Get the answer. 31.10. Now, let's assume current scenario gives an answer of 60 just for an imaginary sake. Revised one gives us 30 just for an imaginary. Here both are lesser than 40. One you get 60, another you get 30. Your advice will be as per the, you will have to write it like this. As per the current condition, the share is undervalued in the market. The fair price is 60, whereas market is giving a price of 40. Hence, we should buy the share. Full stop. However, we should go as per the changed scenario, and as per the changed scenario, the fair price is only this much, market price is so much, and hence we should sell the share. Hence we should sell the advices. Ultimate advice is only based on the change scenario, but ICI may expect you to write two lines, one as per the current scenario, one as per the revised scenario. I'll explain again. You got 60, 30. 60 means market is undervaluing it. 60 is the fair price we calculated and 30 is the fair price we calculated. Market is giving a price of how much? 40. If market gives 40 and you got 60 and 30, your advice very simple. You'll write first point saying that the fair price is 60, actual price is 40, market is undervaluing it, buy the share. However, because of the change scenario, fair price drops from 60 to 30, market is giving 40, share is overvalued, and hence we should sell. In this case, both the prices it is overvalued. So advice is very simple. Market price is higher in comparison to current equilibrium price of 34.42 and revised equity. Under the situation, investor should sell the share. Any doubts on this? Clear? Can we proceed? Now this part alone is a debatable issue. Okay, 2.5 plus 7%, but consistently they do the same thing. Can we proceed? Similar thing is this question. I just want to see the numbers, discuss. You're not going to do it. Okay, holding 1000 shares. Presently, the rate of dividend paid by the company is 2 per share. Share is being sold at 25 per share in the market. Several factors are likely to change. You have the various factors like the previous question. Maybe only reason I would have done is you see the price 13.63, 36.33, 13.63 and 36.33. Existing fair price will not impact the decision. However, ICI solution calculates both existing and revised price, and final decision would be based on revised market price. It is advised that both existing and revised prices computed in exam. My advice will mostly be based on the revised price only, but still I will end up writing this here. In case of existing, equilibrium price is 13, the share needs to be sold. The share needs to be sold. However, under the change scenario, price becomes 36. Investor should hold, or you can technically buy also. Investor should hold, or you can technically by the share. Able to understand this? Two prices will be calculated. One price has zero utility, but ICI will expect you to do it. There could be a step marks around it also, and you will write a line also on that. You will write a line also saying that it is undervalued, buy it, revised scenario overvalued, go ahead and finally sell it. Go ahead and finally sell it. Any doubts on this? Can we proceed? Okay, a small concept called holding period return. Nothing much for me to explain here. Already done in mutual fund chapter. NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0. Here it's called P1 minus P0 plus D1 divided by P0 into 100. Maybe some places I may calculate this. Okay. X dividend price and cum-dividend price, X-dividend price and cum-dividend price. Now, any asset you buy, there are two types of prices are there in an asset. I buy this property on 30th March. If I buy this property on 30th March, and let's assume there are tenants already there in the property, I buy it on 30th March. Whatever price I pay is called cum rent price. What is cum rent prices? I will be paying property value is only 1 crore, but I'll be asked to pay 1 crore plus extra 1 lakh rupee. That extra 1 lakh is because in the month of March on 31st, the tenant will be paying me 1 lakh rupee. The tenant will pay me 1 lakh rupee on 31st March. Any asset has one base price and there is an extra value for the property because rent is going to be immediately paid. There's an X dividend value, cum dividend value, X interest value, cum interest value, X rent value, cum rent value. Property, if you buy on 30th March, you have to pay 1 crore 1 lakh. If you buy it on 31st March, you have to pay only 1 crore. Because if you buy on 31st March, you will not get that 1 lakh rent. If you pay on 30th March, you will get that 1 lakh rent. For decision making purpose, we should always get the X dividend values. We should always get the X dividend values. Any place in any formula you want to use P naught, where will you use P naught? K is equal to D1 by P naught. That P naught should be X dividend value. It should be X dividend value. You calculated a fair market price. You need to compare that with the actual market price X dividend. X dividend. Any value should be X dividend. What is X dividend and cum dividend value? X dividend is real value of the security without accrued dividend. Real value of the property without accrued rent. Accrued rent. Rent keeps getting accrued on a everyday basis. Without accrued rent, if you take, that is called real value of the property. Cum dividend values are X dividend value plus the dividend income. Plus the dividend income. Real value of property 1 crore. Extra 1 lakh you are paying because you are going to get the rental income. Price will fall by the amount of dividend. Price will fall by the amount of dividend once the share becomes X dividend. Value of the property will fall by the amount of rent once the property becomes X rent. What is X rent is? Rent is paid out. If rent is paid out, it will become X rent. Where did we see this concept? In mutual fund. When dividend is paid, NAV will fall by the amount of dividend. NAV will fall by the amount of dividend. So in any calculation, for example, we were doing this fair price calculation earlier, and the question say the actual market price in bracket cum dividend is 25. From the cum dividend, you have to first remove the dividend and then only do comparison. Let's see whether you have understood this. Is a very tricky example. Get me the answer here. It is a tricky example. Let's see. Cost of equity. Get me the cost of equity here. No major numbers, anything, but it's little tricky example. Example 23. Okay, I've got answers in live online. 15? Okay. I've got 15 as some answers and 15.5 even in live online. Now, this is where the mistakes would be made. K is equal to T1 by P naught plus growth rate. P naught is 10. P naught is 10. What is 10? 11 minus 1. D1 is 1 plus the growth rate. Including dividend of 1 means it will be paid in a day or two. This is D0. Including dividend of 1 would mean this is D0. It is cum-dividend price means in few days, 5 days, 10 days, this dividend will be paid. So 1 plus extra 5% on this, 1 plus extra 5%, 1.05 plus 0.05. Some of you in the live online have also told 15%, but the answer is 15.5%. No confusion here. Including dividend means it is going to be paid out in few days. In few days, this dividend will be paid out by the company. Able to understand this? Can we proceed? Any doubts on this? Done? Understood? So again, I'll repeat because see, the point is whatever I teach, it may come back at some point of time later on. X dividend values, cum dividend value. Suddenly in bond valuation, I'll say X interest value and cum interest value. Or suddenly at some other place, I'll say X rent value and cum rent value. So you'll have to be very clear on the concept. Concept is for any calculation, remove this element called accrued interest, accrued dividend, accrued rent. Any formula you want to use, any place you want to use, you'll have to use only the X values and not the cum values. Clear? Okay. Inflation premium. What is inflation premium? Let's understand. Practical world, if I ask you what is the investor's required rate of return, we had a formula called RF plus beta into RM minus RF. So I asked my parents, we want to invest in a property. So they told me to do cash flow analysis. I did cash flow analysis. Year cash flow I calculated. Now I have to discount these cash flow. For discounting, I need the discount rate. I asked them what is the return we want. I asked what is beta of the property. They said we don't understand beta and all. What are you saying? What is beta and all? I don't understand. But somewhere I still wanted the required return. Practical world, the required return is only this. People understand only this way. Risk-free rate plus risk premium. They don't understand anything else. If my parents want to give a loan to someone, first thing in their mind is government gives 7%, which is risk-free rate. To the person whom I'm giving, this person risk is limited, extra 2%. Risk is very high, extra 5%. Risk is extreme, extra 20%. This is what people, any required return. If you give money to Mukesh Ambani, you would want 7 plus 1, 8%. You give money to the other Ambani, Anil Ambani, you would want 7 plus 20%, 27%. Reason is risk is on the higher side, risk is on the lower side. SBI fixed deposit, 7 plus 0.5, 7.5 is sufficient. SBI equity share, 7 plus extra 5, 6, 13% is okay. So required return of any securities, risk-free rate plus risk premium. What is risk-free rate? Risk-free rate, RBI keeps controlling this. Inflation. Inflation goes up, RBI increases the interest rate. Inflation goes down, RBI reduces the interest rate. Inflation has a significant impact on your interest rates in the economy. India's interest rates for a very long period and now also is higher than US interest rate. Reason is inflation is low in US and inflation is high in India. The gap has been coming down. The reason is inflation gap is also coming down. So any person who wants a return for a security, if a US investor invests in US, he may be okay with 6%. An Indian investor may not be okay with 6%. Reason is there inflation is only 2-3%, extra 3-4%. So one, there is an inflation. Second, there's something called as real return on a risk-free security. What is real return is, if inflation is 5 and government pays me 7, I really earn only 2%. I really earn only 2%. the actual return earned by me is not 7% from government of India, it is only extra 2%. So to put it very simple, required return of any of the problems we have done, required return of shares is equal to inflation plus the real return of India plus the risk premium, or in other words, risk free rate plus risk premium. Why am I explaining this? Inflation premium, a word will come in few questions. Inflation premium forms part of risk free rate. Any increase in inflation premium will increase the risk free rate. Any increase in inflation premium will increase the risk free rate. This can also increase the market rate. If risk free rate goes up, market rate can also go up. What is this market rate going up? Today 7%, stock market gives 10%, very happy. If the 7 in India becomes 10, stock market can't give 10. Stock market has to give now 12, 13, 14, 15. I'll repeat again. There's a risk free rate, there's a risk premium. Risk free rate is inflation plus the real rate of return. So risk free rate has two subcomponents. One is inflation premium and the real return. Any increase in inflation premium will increase the risk free rate, and if the risk free rate goes up, along with that, market rate may or may not go up. That's an assumption based area. ICI hasn't been consistent. There was only one question they have done, but there were a lot of assumptions needed in that question. Clear? Understood the concept of inflation premium? Let's see this in a question now. Go through the question, complete part A. Just 2 minutes for you. Part A quickly complete. Part B I'll take you through. 2 minutes for you to complete part A. Got the answers in live online. You complete part A. Part 2 I'll explain. I've got the answers here. You should have also done. P naught is equal to D1 by K minus G. The D1 number is 2 plus, what's the growth rate? 2.14. KE number is RF plus beta into RM minus RF. RF is 9 plus 1.2 into 4, which is what is it? 13.8 minus 7%. What's the answer? 31.47. 31.47, which is what answer students have told me. Any doubts on this? Let's come to the revised part, which is where I want to do a discussion. I hope this part is very clear, straightforward, nothing much for me to discuss. Okay. What would be the equilibrium price? Equilibrium means fair market price when inflation premium increased by 2%, expected growth rate increased by 3%, beta of platinum limited rises to 1.3. Okay, this is study mat question. First thing, is it B, scenario B, that is situation B with 1, 2, 3 separate scenarios, or is it a one problem? We don't know. Assumption. Many assumptions are needed. ICA assumption, all three are happening together. Study mat, they say you can take three individually also. Three separate question or one single question. So they have taken it as one single question. Okay, so that's one part of it. It says inflation premium increases by 2%. Inflation premium increase means risk-free rate will go up. Risk-free rate will go up. In the calculator, do 9 in the calculator. Just do 9 plus 2%. What do you get? 9.18. Now this 2% can be understood as 9% plus 2%, 11%. Can also be understood as 9% plus 2% of 9%, 9.18%. Again assumption, 9% plus 2% of 9%, 9% plus 2% of 9%, 9.18%. Same way with the next one. Growth. Today growth is 7. 7 can be understood as 7 plus 3%, 7.21, or 7% plus 3%, 10%. Consistency is not there. I assume 9 will become 11, and I assume 7 will become 10. I don't know what is there in the answer also. Okay, I'm being very clear. I don't know what is there in the answer, but my assumption is 9 will become 11. Somebody says 9 will become 9.18. Can I do? Go ahead and do it. I have no problem. Okay. And somebody says growth 7 will become 7.21. I've told you in the calculator. In calculator, when you did 9 plus 2%, you got 9.18. And you may get 9% plus 2%, which is 11%. Both are technically fine. Both are technically fine. Now, right. Revised price. D1 by KE minus G. K is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. What is RF today? 9 plus 2%. Inflation premium means increase in RF. Okay, 9 has become 11. Again repeating, I don't know what is there in the answer. We'll see the answer in some time. Purely lot of assumptions are needed here. Beta is how much? 1.3 increases. This is okay. Beta increases to 1.3. Any increase in RF can also increase RM or may not increase RM. Can increase, may not increase. That is also an assumption based area. That is also an assumption based area. I think this came in May 25 mock test paper where they made it very clear what is going to happen. Everything they clearly mention, but they may end up not even clearly mentioning it. Now, what is RM minus RF today? Today RM minus RF is how much? 13 minus 9. So there are two ways to understand this. Whenever RF changes, RM also changes, and RM minus RF remains same. What is RM minus RF? Risk premium of market. Practical world, this is what will happen. If interest rates go up, my expectation from market will go up. My expectation from market will go up. Again, I don't know what is there in the answer. I assume same RM to continue. 13. Same RM to continue. Can I take it as 15? Possible. 15 is extra 2%. Extra 2%. That is a possible assumption. That is a possible. Lot of assumptions are there. ICA, in fact, I think in the study mat ended up giving multiple answers, or they said multiple answers are possible. 13 minus 11%. 13.6. Let's go up now. What was the last year dividend? 2. What is the growth rate now? No, increases. Growth increases to 10%. Growth increases to 10%. Divided by 13.6% minus 10%. Already got the answer in live online. What's the answer you get? Let's see what is there in the answer. I really don't know what assumptions are taken. Here I think assumptions are different. 15. 15 is the assumption. I said answers can change. As I said, answers can change. Inflation premium increases by 2%. Inflation forms part of risk-free rate. Premium will increase risk-free rate from 9 to 11. This can also alternatively be taken as 9 becoming 9.18. Alternatively taken as 9 becoming 9.18. Increase in risk-free rate is assumed to increase market return. Assumed to increase market return. Alternatively, you can assume market return will remain same at 13%. I did that. I did assumption of, because there are too many assumptions here. Else I would mostly give you the answer which is there in the institute study mat, but this question has too many assumptions. It is assumed that all three changes happen together. Growth rate is currently 7, increase will make 10. It is assumed that change is at absolute level. Absolute means 7 plus 3, 10. Relative means 7 plus 3 of 7. 7 plus 3 of 7, 7.21. 7 plus 3 of 7, 7.21. No major computation difficulty or concept difficulty. It is just the assumptions here. This question, I can give 20 different answers depending on assumption. Somebody will say risk-free rate 9. Another answer risk-free rate 9.18. Growth 7. Another answer with 7.21. 2 into 2, 4 answers here itself. Then your market return, you continue, you don't continue, separate changes, all three changes together. So different answers are possible. Ideally, so much confusion may not come in an exam question, but still, the concept I wanted to explain is inflation premium. Inflation premium. Any increase in inflation premium will increase the risk-free rate, which is what you have been learning in your economics and which is what RBI keeps doing it. Any doubts in this? Can we proceed? There's no logic. The point is both answers are possible. You are right in your, so his doubt is why should market return continue at 13%? I logically agree it should not continue at 13%. Institute in their answers have given both. They have given both. In fact, one exam question, they made it very clear. This exam or an MTP, they said in the note, market return will remain same. Market return will remain same. To avoid the confusion for the students, they said market return will remain same. All changes will happen together, and they said 9 will become 11 and 7 will become 7.21, something like that. They said absolute change, relative change. All this they clarified in the question itself. If they clarify, I have no problem. Otherwise, you are perfectly right. 13 should become 15. 13 should become 15. Any doubts on this? Now I go to the next model, which is an extremely important one. Again, we are following, continuing with only Gordon's model. Now let's understand what is this. I have to do a valuation of a share. For valuation of share, Gordon says P naught is equal to D1 KE minus G. So then I asked the D1. For D1, you said growth rate year 1 10%, year 2 8%, year 3 6%, year 4 4%. This is the growth rate you are saying. After year 4 till infinity, because an equity share has no end, till infinity the growth rate is 4%. 10, 8, 6 and 4. Last dividend was 2 rupees. So I asked 2 plus 10%, no problem. Okay, last year was 2 rupees, now 2 plus 10%. KE 15%. I asked growth. You're saying 10, 8, 6, 4. This is called step up or step down growth model. Step up or step down growth model. Now what Gordon said is you can use my formula, Gordon's formula, only when you have a single growth rate. Only when you have a single growth rate. If you have a multiple growth rate, you cannot use my formula. Then what will I do? Visualize. Year 1 is over. Year 1 is over. Now if I ask you growth rate, you will say 8, 6, 4. Still I don't like it. I want only one answer. Year 2 is also over. Year 2 is also over. What will be the growth after year 2? 6 and 4. I don't like the answer. Year 3 also over. Year 3 also over. What is the growth rate? 4. P3 is equal to D4 by KE minus G. P3 is equal to D4 by KE minus G. When I ask you this, you give me only single growth rate. Till you give me single growth rate, I cannot use Gordon's formula. Okay, I have got P3. I have to go to P0. One approach, which is a longer approach, is Modigliani-Miller. From P3 go to P2, from P2 go to P1, from P1 go to P0, which is a longer approach. Will it give the same answer which I am going to do in the other approach? Yes, same answer. Longer approach, one question we did that because I wanted price of every year. Then what will I do here? I'll do year cash flow. First year, dividend income. Second year, dividend income. Third year, dividend income. At the end of third year, price. Logic is you are selling it at the end of third year. Logic is you are selling it at the end of third year. Whether you sell it or don't sell it, I'm not bothered about it. Whether you sell it or don't sell it, that's not my worry. You are doing the calculation as if you are going to sell the share at the end of third year. This is what the model is. Value of share is equal to present value of dividend plus present value of sale proceeds of share price on sales. Should sales be done? Not mandatory. It is just a valuation exercise. So step 1, PV of dividend. Compute dividend till the growth stability. Whenever growth is stabilizing. Whenever growth is stabilizing. Compute price at the beginning of the stabilization. Beginning of the stabilization means fourth year stability happens. Beginning of year 4 is called end of year 3. Beginning of year 4 is called end of year 3. Till growth stabilizes or till you give me single answer for growth rate. If you give me two answers, I don't like it. I cannot use it in the formula. Till you give me single answer, this exercise will keep going on. Discount step 1 and step 2 at KE or investor required return and compute the share price. Under a step up growth model, what will happen? What will happen is you will have first year dividend, second year dividend, third year dividend, fourth, fifth, sixth, and at last year you'll have to write two numbers, one dividend as well as price, assuming you sell it at that price. It could be P6, P7, P4, P3 depending on when the stability is happening. I have to wait till the year of stabilization. I'll have to wait till the year of stabilization. Practical world, single growth rate assumption is not logical, because in a practical world you cannot have a single growth rate. Growth rate can keep changing. Till you give me a single answer, I cannot use Gordon's formula. Once you have given me a single answer, I will start doing the Gordon's formula. This refers to a scenario where growth happens in multiple stages: an initial stage, an intermediate stage, final stage. It talks about 3 points. It can be 3, 4, 5, 6, 7, any number. I'm not bothered. We should compute dividends till the year of stabilization. Stabilization is reached when growth as well as K is stabilized. What is K is stabilizes? Cost of equity can also change, because the point is I want the denominator, like growth, KE today is 18, then 16, then 14, then 12. KE can also change. What happens if KE changes? How you do discounting? That I'll explain later. That part I'll explain later. But KE can also change. Dividends growth rate can also change. Till stability happens, the formula cannot be used. Clear? Now let's see a simple example. Last paid dividend is 10. Same will grow at 20% for 2 years. Growth will stabilize at third year is the stability. Third year is the stability. You have to calculate dividends of first year, second year, third year. First year will come in the cash flow. Second year will come in the cash flow. Third year will help me in calculating price. Third year will help me in calculating price. I don't want you to write anything. Tell me what will be first year dividend. Last year 10 rupees. What is the growth? So what will it be? 12. Second year 14.4. Third year 15.84. First year dividend, second year dividend, third year dividend. Some question it can go on till 8 years, 9 years, 10 years and all. If they want to make it complicated, they can keep increasing the number of years. So 12, 14.4 and 15.84. We got the numbers. Now what will we do is P2 is equal to D3 by KE minus G. Historical cost of equity 22, but today onwards cost of equity is 20%. I'm interested only in what is future. Future is 20%. So you see the calculation, 20 minus 10 and you do the valuation. Once this is done, this MCQ is done, the concept is over. Technically, any problem I do after this, just time pass. But once this example is understood, you have understood the concept. I'll repeat again. Growth can happen in multiple stages. We need to wait till the growth stabilizes. Stability of growth can happen in any year. Once the stability is achieved, you will then end up computing the price in that year. It could be 5th year stability, 4th year price, 10th year stability, 9th year price, 20th year stability, 19th year price. Till you calculate price, you will have to write dividends discounted, that's called present value of dividend, and present value of share price on sale. Stability is from year 1 itself, which is what P naught is equal to D1 by Ke minus G. So it is not a new model and all. The formula D1 by Ke minus G only I can use, but I have to delay the usage of it, maybe to the 3rd year, 4th year, 5th year. After you get 5th year, I want to come to 4th year, not by this logic. Do Modigliani-Miller, which will take more time. 5th to 4th, 4th to 3rd, 3rd to 2nd, 2nd to 1st, 1st to year 0. Both are technically same answer you'll get. Rounding of differences can be there. Any doubts on the concept here? Any doubts on the concept? Can we proceed? Let's come to this question. MNP Limited has declared and paid annual dividend of 4 per share. It will grow at 20% for the next 2 years and 10% thereafter. Required rate of return of equity investor is 15%. Compute the current price at which equity shares should sell. Present value interest factor, they have given 4 decimal factor. Calculations shall be rounded off to 3 decimals. 3 decimal. Nothing much for you to read in the question. Let's read it again. What is the growth rate originally? How many years? 2 years. When is it stabilizing? 3rd year. If it stabilizes in the 3rd year, calculate dividends for 3 years. Price at the beginning of 3rd year, which is called end of 2nd year, and do discounting. Year growth rate dividend. First, year growth rate dividend. Year 1, year 2, year 3. Year growth rate and dividend. Year 1, 2, and 3. What is the growth rate given in the question? 20%, again 20%, then 20, 20, and 10. What was the dividend last year? 4. 4 plus 20%, 4.8. Again plus 20%, 10%, 6.3 decimal, 3 decimal they have told. 3, 3. Question has crystal clear mentioned 3 decimal calculation, 6.336. Any doubts on this? Can you proceed? 6.336, done. This is note 1. This is dividend calculation. Note 2. Price at beginning. Price at beginning of stability. In bracket, beginning of year 3, end of year 2. Beginning of year 3 is end of year 2. Beginning of 3rd year, end of 2nd year. Beginning of 3rd year, end of 2nd year. P2, D3. This area also is done at CA Inter as part of dividends chapter. You would have done it, but okay. P2 D3 by K minus G. What is the D3 number? KE number 15%. What is the growth rate after 2nd year? 10%, minus 0.10. 126 point. Any doubts on this? Clear? Can you proceed? So I've calculated dividends, I've calculated price. Now I just need to do discounting. I just need to do discounting of this. Any doubts on this? Year, cash flow, PVF at what rate? 15%. DCF. Year 1, 2, and 2 again. Year 1, year 2, and 2 again. Year 1, what was the dividend? Year 2, Listen, this 2 is nothing but technically 3 to infinity. 2 is nothing but you value the perpetuity. So 2 is nothing but year 3 to infinity. That is valued a year in advance. In short, you're writing first year, second year, third, fourth, fifth, sixth, seventh, eighth. In Excel, I can write 1000 years and do the calculation. For us, we need a short approach, which is where this comes into picture. What was the price? 126.72. You can get the answer. I'm not interested much in this. 4 decimal PVF. PVF has to be 4 decimal given in the question, and DCF will be 3 decimal. It should have been 3 decimal. I don't know. Maybe an error from my side. 104.34. DCF should have been 3 decimal. I don't know. Maybe some error from my side. Any doubts in this? Clear? I'll explain again. I calculate dividends for the number of years till growth stabilizes. Stability can take a lot of time. Till the stability happens, I will have to do the calculation. First year, second year, third, fourth, fifth, whichever year the stability happens. Dividends discounted and price discounted. Always be clear. Whichever is the last year will get repeated twice. Second year means 2 times second year. 10th year means 2 times 10th year. Dividend and then the price. Any doubts in this? Can we proceed? Clear? Able to understand this? Okay. Same thing came in a July 21 exam where they gave the price. They gave this. They made this as balancing missing information. They made this as missing information. What is missing is dividend was missing. Same thing you will understand when I do a question. It's a reverse working question. They gave the price, but they made something else as missing information. Let's see it now. NML is aspiring to enter capital market in a 3 years time. Board wants to attain a price of 70 for its share at the end of 3 years. 70 for its share at the end of 3 years. Present value of its shares is 52.03. Today the price is 52.03. Dividend will grow at the rate of 15% for the next 3 years. NML uses dividend growth model for its projection. Required rate of return is 15%. You are required to calculate the amount of dividend to be declared by the board in the base year. Base year means year 0. In the base year, so as to achieve the target price. Again, 4 decimal PVF has been given. I'll explain again. I want to enter capital market in a 3 years time. Board wants to achieve a price of 70 at the end of this. 70 is nothing but your 126.72. You calculated 126.72 in the last problem. Second year price. They are saying third year the price has to be 70. So P3, which is D4 by KE minus G, whatever they would have done, they have given you the price. They are saying I don't want to confuse you much. I'm giving you the price. Price is how much? 70. Today the share price is 52.03. What was the last year dividend? What is the last year dividend? That is what you are calculating. Last line says what should be the dividend declared in the base year. So last year dividend is A. First year dividend A plus 15%. Second year plus another 15%. Third year plus another 15% into PVF DCF. This is what we are going to do. You have understood the question first. It says I want to enter capital market in a 3 years time. Board wants to achieve a target price of 70 at the end of 3 years. Present value of its share is 52.03. Share price they have given 2 decimal. So cash flow we will do 2 decimal, but PVF is given 4 decimal. Growth will be 15% for 3 years. What happens after 3 years? I don't know, and I am also not interested in knowing as of now. Doesn't really matter. Now write year cash flow PVF DCF. Year 1. Directly the table, okay. Year cash flow PVF DCF. Last year my dividend is A. Next year the growth is how much? 1.15 A. 15% growth. 1.15 A X whatever 1.15 X or A. Year 2 1.15 plus 15%. 3225 A. 3225 A. Third year another 15%. Let's keep it as 4 decimal 5209 A. Third year 2 times third year. 2 times third year. Be very clear on this. Whichever year is the last year, it will repeat twice. It will repeat twice. 1.15, 3225, 5209 and third year 70. If I want to complicate, I could have given you fourth year growth as some 5%. P3 is equal to D4 by KE minus G. That would also come in terms of A, but they say let's not complicate. I'll give you the number. Total of this is 52.03. Total is 52.03. It's a reverse working on the dividend amount. It's a reverse working on the dividend amount where third year price is given directly to you. They are not complicating the question. They say we will give you the third year price directly. PVF from the question 0.8696. Multiply and tell me 1.15 into 0.8696. Mostly you will get all the 3 as A only, which is what I remember, but you do the multiplication and check. When you multiply, you will get it as A. That's how the question has been drafted by them. That's okay. When you multiply, you will be getting A. You can check the numbers. 1.15 into 8696, 1.3225, again 1.5209. All the 3 are getting 1. Tell me 70 into 0.6575. 2 decimal 46.03. Now you'll get the answer to A. You will get answer to A. A plus 46 is 52. So last year dividend should be 2. Next year 2 plus 15% plus 15 plus 15, and then this happens. Any doubts in this? This was one variant they tested where they said I will not give you the dividend amount, you do the calculation. Any doubts on this? Any doubts on the approach? Can we proceed? Clear? Anybody has any doubts, any confusion, you'll have to tell me. Can we proceed? Another variant is this. Let's read it now. Okay, before I come to it, let me quickly do few more things. Any doubts on step up growth model? Okay. Change in growth rate with change in payout ratio. Change in growth rate with change in payout ratio. Dividend estimation for future period. I want to estimate dividend for future period. Why I want to estimate? Step up growth model says estimate dividends till the year of stability. If there is no change in payout ratio, then very simple calculation. Last year dividend plus 10 plus 10 plus 20 plus 30, whatever we did in the previous questions. If there is a change in payout ratio, what is change in payout ratio is? Year EPS DPS. First year 10 rupees, dividend is 1, 10% payout only. Second year earning will grow at the rate of 10%, 11. Dividend will not grow at the rate of 10%. Reason is this year 10% payout, next year 15, next year 20, next year 25, 30, 35, 40, 45, 50. Till 50 it will keep on changing. Till 50 I will keep on changing it. In case there is a change in payout ratio, you cannot say 1 plus 10%. What you need to do is 11 into 15%. 11 into 15%. I'll explain again. In case there is a change in payout ratio, what is payout ratio is? The dividends as a proportion of earning. Earning is 10, dividend is 1 rupee originally. 10 will grow by 10%. It will become 11. but 1 will not become 1.1. Reason is there is a change in payout ratio. So concept says if there is a change in payout ratio, estimate EPS of future years, EPS of earlier year plus the growth rate, and future dividend is equal to EPS into payout ratio. EPS into payout ratio. Able to understand this concept? I'll explain this better with the this example below you do at home, but I'll do a descriptive question. I'll explain again. If there is no change in payout ratio, go with the past dividend, add growth rate, calculate the new dividends. That is a very simple approach. In case there's a change in payout ratio, you cannot estimate dividends. You have to estimate EPS, then estimate dividend, then do discounting. Could be 5 years, 10 years, 15 years, 20 years, 25 years. It can be any number of years. Clear? I'll come to 19 in some time. Okay, one more concept. Any doubts first on this change in payout ratio? If there is anywhere a reference of payout ratio in the question, calculate earnings first and then calculate dividends. Extra work for us, but we have to do. Calculate earnings and then calculate dividends. In case there is no change in payout ratio, only dividends is sufficient. Last question, you never talked about earnings. Even the previous question, we never talked about earnings. This is one point. Second is linear fall in growth rate. Linear fall in growth rate. Let's understand what is linear fall in growth rate. Question may say that growth rate 10% till 5 years. 10% till 5 years. Thereafter, it will linearly decline to 5% by or to 1%. It will linearly decline to 1% by year 8. By year 8, it will become 1%. 10% till 5 years. Linear decline means uniform fall in growth rate. Decline can also be there, increase can also be there. So 10% in the 5th year, it will become 1% in 8th year. So 10 minus 1, 9% fall will happen. 10 minus 1, 9% fall. In how many years? 5th year till the 8th year. 3 years. Every year 3% fall. So 10% growth for the first 5 years, then 7, then 4, then 1. Thereafter 1. Thereafter it is 1. Some question will say 10% till 5 years, linearly decline and stabilize at 8%. Linearly decline and stabilize at 6%. Stabilize at 6%. How many years? I don't give you. In that case, ICI assumes that it will be 1% fall every year. 1% fall every year. Why is this needed? To calculate dividends. To calculate dividend. Growth rate, ideally, question can easily give me the growth rate. Why to complicate? They could have told me growth rate is 10%, then 12%, 5%, then 4%. Something like that, I'm happy to do it. But if I want to complicate a question, I'll say growth will be 10% for 5 years, linearly decline or linearly increase. It can be either ways. So number of years of fall is given. Annual fall is higher rate minus lower rate by number of years of fall. Number of years of fall not given. Take 1% fall every year. Take 1% fall every year. Can you give me answer to this example? A fairly simple example. In this example, in how many years the fall will happen? Is it given? No. 20% for 4 years. 20 will become 19. 19 will become 18 in the 6th year. 19 will become 18 in the 6th year. 17 in the 7th year. 16 in the 8th year. 15 in the 9th year. 14 in the 10th year. 10th year is the stability. 10th year is the stability. Number of years is not given. 1% change. 1% change. So 14, it has not been mentioned the fall is for how many years. 14 will become, sorry, yeah, 20 will become 19. 19 will become 18 in the 6th year. Clear? Give me answer to the next one. Live online guys, you also participate. 27th example. Already got the answers here. What will be the annual fall in growth rate? 2%. How 2%? Higher number is 20. Lower number is 14. In how many years? 4 to 7, 3 years. So every year the fall is 2%. 20 will become 18. 18 will become 16. 16 will become 14. Any doubts on this? Clear? Two major concepts I've done. Both the concept will get tested now in a question. One is called linear fall in growth rate. Number of years given, calculate the percentage fall every year. Number of years not given, 1% fall every year. 1% fall every year. Clear? Able to understand this? 20, 19, 18, 17, 16. I am going to do a question in Excel. You are not going to do it because it's a 10-year calculation. You will unnecessarily waste time on calculation. So you will understand fully, but I'll do it in Excel. First, go through this question 20. Go through 20. Okay, I will start reading it. Current EPS means E0. E0 is 4. Company has shown an extraordinary growth of 40% in its earnings last year. This growth will continue for the next 5 years. Next 5 years. After which it will decline from 40 to 10. How many years? 5 years. During the next 5 years, 40 will become 10. So annual fall in growth rate we have to calculate. Then the decline in the growth rate will be equal and linear. Currently, the payout ratio is 10%, will remain the same for the next 5 years, and from the beginning of the 6th year till the end of the 10th year will linearly increase. Will linearly increase. Payout ratio will increase, growth will decrease. I have to estimate EPS, then I have to estimate dividend per share. The fall from 40%, it will keep falling. Now I am going to do one table which we will do it together. Year, growth rate, payout ratio. This we will do it together. After this is done, all calculations in Excel. Okay. So growth rate is given in the question. We'll start doing it. Post-tax cost of capital is 17%, which is your KE. You are required to calculate the intrinsic value based on the dividend. Current price is 125. Is it advisable to buy or not? Clear? Let's start. Year, growth rate, payout ratio. This alone you'll have to write along with me. Growth rate and payout ratio. Growth rate and payout ratio. Year 1, 40%. What is the payout ratio given in the question? 10%. Year 2, 40, 10, 3, 4, 5. Till this no changes. Clear? Next. leave some space for writing 6, 7, 8, 9, 10. Annual fall in growth rate. Annual fall in growth rate. Annual fall in growth rate. 40 will become how much? 10 in how many years? 40 minus 10, 5 years. What is the fall? 6%, right? Year 6, 7, 8, 9, 10. Year 6, 34%. Year 7, 28%. Year 8, 22%. Year 9, 16%. Year 10, 10%. Clear? 6% fall. 6% fall every year. Any doubts in this? Can we proceed over a period of 5 years? Over a period of 5 years. Then annual increase in payout ratio. Increase in payout ratio. What is the payout ratio today? It will increase to how much? 50%. 50 minus 10. 50 minus 10 over how many years? 5 years. What is the increase? 8%. That's all. 10 will become 18. 18 will become 26. 26 will become 34. 34 will become 42. 42 will become 50. Any doubts on this? If the number of years were lesser, I would have told you to do along with me. Now I'll do it in Excel beyond this. Any doubts on this? Any doubts on this? So in such a question, what you need to do when there is a change in payout ratio, year, growth rate, EPS, payout ratio, DPS. We had started totally 10 years is the calculation. Growth rate was 40 and then it became 34, 28, 22, 16, 10. What was the last year dividend? EPS? EPS. Last year EPS is 4, 1 plus 40% became 5.6. Then just give me. Then 7.84. This will keep going on. This is the estimation of your earnings. You will have to estimate the earnings like this. Payout ratio originally how much? 10%. Increases to 18, then 26, 34, 42, 50. Dividend is EPS into payout ratio. Clear? You will have to do this. 10th year is the stability. Somebody may say 10th year stability, somebody may say 11th year stability. Both are technically okay. Both are technically okay. Final answer will remain same. P9 is equal to D10 by KE minus G. P9 is equal to D10 by KE minus G. So P9 is equal to D10 by KE minus G. Some rounding of differences can be there in the answer. What is the 10th year dividend? 28.74. 28.74. P9 is equal to D10 by KE minus G. My answer could do P10 equal to D11. Both final answer will remain same. Okay. D10 by KE minus G. D10 is 28.74. What is the cost of equity in the question? What is the growth rate of 10th year? After this it is 10%. After this it is 10%. So I get prices. Can you calculate the price? 28.74 divided by 410.57. I have to discount this and get the price, which is what we would have done here. 410.14, that's rounding of difference. And this is year 9. This is just a typing mistake. 118.53. 118.53. Fair price 118. Actual price 125. I will not be buying the share. I will not be buying the share. I'll technically sell it. Any doubts on this? Calculations, I don't want you to waste time. P9 D10 by K minus G. Any doubts on this? Any doubts on this calculation? Anybody has any doubts on this? Can we proceed? Done. A variant of this came in May 23 exam. Go through this first. This question we will do it together. We'll do this together. Let's understand. An investor is considering purchasing equity shares of Alpha Limited, whose current market price is 172.45. Company is proposing a dividend of 6 for the year ending 31st March 2024. Alpha Limited will grow at 20% for the next 4 years. Thereafter, the growth over the next 3 years will linearly decline by 100 basis points per annum. 100 basis point means 1%. 1 basis point is 0.01%. Thereafter, it will stabilize at a certain growth rate per annum infinitely. What growth rate? I don't know. Infinitely, it will stabilize at some growth rate. The required rate of return is 20%. 20% basically indicates your KE. Dividend values to be taken in 2 decimal points only. You are required to calculate the stable growth rate after the end of 7 years. So I am not giving you the growth rate after the stability. After the stability means P7 is equal to D8 by K minus G. That G I am not giving you. That G I am not giving you. You do your calculation on that growth rate. P7 is equal to D8. We did one reverse working question where dividend was not given. This question, dividend is given, initial growth rates are given, but the confusion they ended up doing on the infinite growth rate. That infinite growth rate I'm not giving you. What is the stable growth rate after the end of 7 years? And advise whether it is worthwhile to purchase. If I want a stable growth rate of 15%, valuation is giving 16, 17, 14, 13. We'll do the calculation. Able to understand this? What is the today's share price? The dividend, this I assume is the last year dividend. Okay, 6 rupees. I don't know what is there in the answer. Okay, 6 year is the, let me take the same assumption. Okay, they have taken 6 as year 1 dividend. They have taken 6 as year 1 dividend. Okay, let's follow that then, because if I take this as year 0 dividend, then my answer will undergo change. 6 rupees grow at 20% for the next 4 years. 4 years means the 6 is year 1, that is already done. Second year, another 20%, another 20%, another 20%, and thereafter 19, 18, 17. Thereafter, what is the growth? I don't know. I don't know what is the growth after which year? After 7th year. Clear? Any doubts in this? Now, right, working note 1. Dividend still 7 years. Are you right? Year, directly write this. Year, cash flow, PVF at what rate? Some rate they have given in the question. Sorry? PVF at 20%. DCF. Year 1. Year 1, 6 rupees. This is assumption based area. Okay, I can't help it. Year 2, add 20%. 6 plus 20%. Year 3, again add 20%. Year 4, again add 20%. Two decimal question very clearly said. This is first 4 year growth is over. Okay, year 1, that 6 is including the 20% growth. Year 1, 6 rupees, 7.2, 8.64, 10.37. Year 5, 19% growth. 12 point. Year 6, 18% growth rate. 14 point. Year 7, 17 point. Year 8, I don't know. That is what is the problem. The problem is 8th year dividend depends on the stable growth rate, which they have not given, but they have given some information for us to calculate this. Any doubts first on this? They have given last the 6 rupees for the year ending 31st March 2024. This came in exam in May 23. I'm not sure, still the drafting could have been little better, but that has taken us D1, 20% for second year, third year, fourth year. That 6 rupees includes that growth. Okay. Fifth year is 19%. Sixth year is 18%. Seventh year is 17%. After that, what is the growth? I don't know. Now, year 7, another year 7, there will be a price here. I'll come to that in some time. There will be a price which will come here. Okay. The total of this is today's price. What is the today's price given in the question? 172.45. Any doubts on this? I'm just writing here cash flow, PVF, DCF. You'll have to be very clear on the logic. Now, what I want you to do is you keep doing it. Write the PVF, write the DCF. This will be balancing figure. Write the PVF, write the DCF. Last year, 7th year, DCF will be balancing figure. 1 divided by 1.2. 4 decimal they have told. Let me know the balancing figure if you've got it. 137.85. Yeah, 137.85. Live online guys, you can also confirm 137.85. Any doubts in that? 137.85. Reverse work and tell me this number now. This into 0.2791 is 137. Some number into 0.2791 is 137. Reverse work 137.85 divided by 2791. 493 point. Any doubts on this? Excellent question. Very well drafted by ICI. Only that 6 rupees they could have done little better drafting, but otherwise well drafted. Any doubts on 493.91? Same approach. First question I did valuation. Second question dividend balancing figure. Third question now, growth balancing figure. Any doubts on 493.91? Can we proceed? Now come down. P7 is equal to D7 into 1 plus growth rate divided by KE minus growth rate. D8. P7 is equal to D8 by KE minus G. What is D8? D7 into 1 plus growth rate. What is the growth rate? I don't know. D7 into 1 plus growth rate divided by KE minus G. Very well drafted question. Excellent problem. P7 is equal to D7 into 1 plus G divided by KE minus G. P7 is equal to D8. D8 is D7 into 1 plus G. 493.91. 493.91. What is the D7 number? Into 1 plus G. G is the stable growth rate. What is the KE number? 0.2. Solve this, you will get G. One question where we did valuation, one question where we found dividend as balancing figure, now growth is balancing figure. %16. ठीक है. So 19, 18, 17, 16. ठीक है. But that's more of coincidence. But 16% is what you're getting. $493.91 into 0.2. Reverse working question. Don't write percentages. You'll unnecessarily make mistakes. 98.782 minus 493.91 G. 17.04 plus 17.04 G. G, as students have said, it is 16%. Any doubts in this? Clear? P7 now. How will it be P8? End of 7 years is P7. End of 7 years, 7th year, no? Tell me. End of 7 years means 7th year only, no? Beginning of 8th year means end of 7th year. If that's it, beginning of 8th year, again 7th year only. And as I said, when you do valuation, year 7, last year will get repeated twice. Last year has to get repeated twice, which is what has happened in this question. The last year got repeated twice. Previous questions you see, last year would have got repeated twice. Any problem on the Gordon's model, which you do, step up growth model, the last year will get repeated twice. Clear, not clear? Tell me, where is the confusion? You'll have to tell me. No, tell me. P7 is end of 7th year or beginning of 8th year, both are same only. For doing P7, you will need 8th year dividend. That's the only point. Any doubts in this? And to advise whether it's worthwhile, if the target growth is 15%, I think it is look 16 versus 15. So comparison we do, since growth rate is more than the target growth rate, it is worthwhile to purchase the share. Able to understand this? So we have seen one question where we had to do the price calculation, one question where dividend was balancing figure, one question where growth has become balancing figure. Any doubts in this? Can we proceed? And we have also seen step up growth rate, linear fall in growth rate or linear increase in payout ratio. Okay, your institute study material has a model called H model of valuation. I really don't see this getting tested in exam. Also, we don't follow this in most of the times, but still material as study material as, that's why I'll discuss this H model. I don't see this to be very critical because there are logical gaps here. Okay, what does H model says? A company will grow at two rates. One is called extraordinary rate and second is a stable rate. Like last to last question we did, we had 40%, then it became 10%. Extraordinary rate and there is a stable rate, 40% and 10%. This 40 to 10 transition will happen over 5 years, 10 years, 15 years, 20 years, some period. H model says for doing valuation, you assume that stability happened today itself. Stability happened today itself. Assume that way and do it. Okay, assume that way and do it. Dividend paid in last year 25. Cost of equity 8%. High growth rate 12%. Now long term growth rate 5%. High growth is for only few years and then it will stabilize at 5%. Number of years for transition from high growth to the low growth rate is 5 years. In 5 years this transition will happen. Assuming today it is stable. Today itself it is stabilizing. If it stabilizes today, P naught is equal to D1 by KE minus G. What was the last year dividend in this example? 25. Today stability happened. Today stability means 5%. 25 plus 5% is K is how much in this example? Growth rate 5%. Tell me this first. I'll again repeat. First, you have to assume stability happened today. Stability happened today. Whether logical, not logical, let's not worry about it. That's why this is not predominantly used in problem solving, practical world also. So, assuming it stabilized today, D0 into 1 plus normal growth rate. What is normal growth rate? 5% divided by KE minus normal growth rate. Assuming it stabilized today, there is one part of the calculation 875. One part of the calculation 875. Then he said, you are saying it stabilized today, which is not logical, which he also agrees. Stability today is not logical, and he also agrees saying that no, stability did not happen today. First he says stability happened, then he says stability cannot happen today and all. This is not logical. Then he goes ahead and says, I want to give some extra to you because you are growing at a high rate. You are growing at a high rate. I want to give you extra value. The growth is 12%. This will become 5% in 5 years. So ideally what he said is 12 will become 5, gap is 7%. Next year 12 would have become 10, gap is 5%. Then it would have become maybe 8, then it would have become 6, then it would have become 5. It will reach 12 to 5 in some years. In how many years? 5 years. So he says there is a extra growth of 7%. Extra growth of 7%. 7% benefit you will not get for all 5 years. Some years you will get 7% extra, some year 6% extra, some year 5% extra, some years 4% extra, and ultimately you will reach that number. So he says this extra growth you are getting, we will give extra value for that. What is the extra value? Today's price, that is today's dividend into the extra, but the benefit is not for 5 years, benefit is for half of 5 years. Benefit is for half of 5 years. Why not for 5 years? Because it is not extra 7% for all the years. 12 versus 5 in the first year, 10 versus 5 in the second year, 8 versus 5 in the third year, 7 versus 5 in the fourth year, 5 versus 5 in the fifth year. It will become equal after some time. So he says, I agree, there is an extra growth, benefit has to be given, that also is agreed, but the benefit can't be for all the 5 years. Benefit will be for lesser number of years. So he says give benefit for half of the transition period. Logic for half and all is not explained. Okay, half of the transition period, which is 2.5. This is like extra value discounted at same KE minus G. Discounted at same KE minus G. I'll explain the formula again. The formula which is used is D0 into 1 plus stable growth rate divided by KE minus stable growth rate, assuming stability happened today itself. 25 into 1 plus 0.05 divided by 0.08 minus 0.05. Extra benefit, same denominator. Extra benefit, same denominator. same 25. On this 25, give benefit for your extra growth. What is the extra growth? 0.12 minus 0.05. 0.12 minus 0.05. How many years benefit? Not 5 years. The benefit is for half of the transition period. Why half? Because few years you are above that by 7, 6, 5, 4. Ideally, you should not give benefit for 0.12 minus 0.05. You should have given for lesser period, lesser growth. But they said let it be as it is, but give benefit for half of the transition period. Half of the transition period is 5 by 2. Can you tell me what is the answer to this? 25 into 0.12 minus 0.05 into 5 by 2. 145.83. This part I would want you to do day before exam. If at all I don't see it to be tested. Again, I really don't expect this to be tested. It is there in institute study material. If at all they want to make a complex paper, because the recent AFM, lot of students score exemptions. If at all they get into a tough paper, two ways they'll get into. One is reverse working questions. Second way, they may ask questions which are unexpected. Areas which are unexpected can be asked. And third one is asking extremely complex question. If they end up asking extremely complex question, even if you solve another 1,000 questions in my class also, you will not get grip on those questions. So there are increasingly people will talk about saying difficult paper can come. It's not in our control. You don't worry about the difficulty of the paper. You do your part of preparation. A difficult or easy paper I cannot really estimate. May 24 was a simple paper. November 24 was a reverse working, little challenging paper. May 25 easy. September 25 easy. Most of the times you will be in a position to answer it with the concept book full understanding itself. If you have good understanding of concepts, you will be able to handle it. Else you will find it difficult. The last question which I did, that growth rate calculation, if it suddenly comes in exam, you will start struggling, saying that what is this, what have they asked. Now I have done it, you will be able to do it. But now what ICI will do is, I would have done some other question where I did not discuss a reverse working. They may end up asking a reverse working there, which because concept clarity grip is not there, you will end up struggling. So that is the only point. As long as you have grip on the concept, any type of question can be handled. Extremely complex paper, again I'm repeating, if it becomes very difficult paper, I can do another 1,000 questions in my class also. Grip will not come. Not only for you, if it's a very different kind of a question, it is difficult for me also to understand and then get to the answer. In exam, stress will be difficult only. Clear? Can we proceed? Done. So we are done with H model, which there is the same example is there in the study mat, in my question bank. Okay, there are certain other approaches of valuation. Before that, I get to another area and I'll come back to this. How to compute cost of GDR. GDR is Global Depository Receipt. Let me first explain this and then we do the cost calculation of this. What is Global Depository Receipt is? Indian company. Let's take example Infosys. Infosys India wants to raise money from US investors. I want to raise some 10,000 crores. I can do an IPO in India, IPO or a revised fund offer and get money from public, or a rights issue and I get money from public. But when the size is very high, I want US participation, UK participation. I want these guys to participate in my company. They are saying, yes, we like Infosys, but we will invest only in US dollar. We will not give you INR and all. I don't want to take any currency risk and all. I'm ready to invest, but I'll invest only in US dollar. I will not give INR and all. Don't expect me to give INR, which is where this instrument will come called as GDR. GDR is called Global Depository Receipt. If you issue this in US, it will be called American Depository Receipt, ADR. If a US company issues it in India, it will be called Indian Depository Receipt, IDR. The name is Depository Receipt. It can be called Global Depository Receipt, American Depository Receipt, Indian Depository Receipt. Somebody is going to issue this at some place. Infosys, what it does is it deposits some 10,000 shares with a custodian bank. Somebody is going to act as a custodian bank, some financial institution. I give and hand over 10,000 shares to them, not physically, but in some way I give it to them. Infosys, once I give this to the custodian bank, he says 10 shares can become 1 GDR. 10 shares can become 1 GDR. So 10,000 shares will become 1000 GDR. 10,000 shares will become 1000 GDR. I call the US the investor and gives him GDR, which is listed in America. It will be listed in US. Infosys ADR. It is a listed one. It is traded in the market. This is the share price of Infosys ADR, $16.5. Whatever is the chart you see here, this is for a year. Exactly same chart. Exactly same chart will be Infosys India chart in India. Exactly same thing. Just give me a minute. Infosys India. This is the chart in India. Exactly similar will be the chart in US. The price goes up in India, price will go up in US. Price goes up in US, price will go up in India. To put it very simply, ADR is nothing but an equity share. ADR is nothing but an equity share. Many a times in India, results are declared after the market closes. Once the results are declared, the price reaction may happen in US because the market will be open there. So people will say in US it has gone up, next day in India it will go up. Suddenly some news comes. In India it goes up, by evening it will react in US. So it is a equity share. It is a equity share. GDR are issued on the security of share and issues in US dollar. Investor invest money through GDR, gets regular dividend income when Infosys declares dividend. Instrument is same as equity. Cost of GDR is same as cost of equity. Cost of GDR is same as cost of equity. What is the formula? D1 by P naught minus F will come. Some flotation cost could be there, plus growth rate, plus growth rate. You can do this calculation in INR. You can do this calculation in US dollar. Answer will remain same. Answer will remain same. What is ADR? ADR is an equity share which is issued in US by an Indian company to raise money from those people. India declared dividend, those guys will also get dividend. Only thing is 1 GDR could be equal to 3 shares, 4 shares, or could be equal to 1 share also. There will be some ratio. There will be some ratio. A global depository receipt is a financial instrument issued by a foreign depository bank representing shares of a company. It allows investors to trade shares in international market without direct ownership of underlying share, enhancing global accessibility and liquidity. My US Infosys India shares are listed technically there, so people will be interested. Cost of GDR is same as cost of equity. Cost of GDR D1 by P naught minus F plus growth rate. Let's see an example. Cum-Dividend Price. First of all, I don't like this Cum-Dividend Price. I don't like this word Cum-Dividend Price. Cum-Dividend Price means first get the X-Dividend Price. Cum-Dividend Price is 400. Dividend is how much? 20. So the share price is not 400. The share price is 5 shares underline 1 GDR. 5 shares underline 1 GDR. So 1 GDR is equal to 5 shares equal to 5 into 380,900. 5 into 380,900. Shares will be priced at a discount of 20%. I want to make them happy. I want to issue it at a discount of 20%. That's my wish. At a discount of 20%. So my issue price is minus 20% here. Issue price is minus 20%. What is the issue price? 1520 or $15.2. 100 rupee per dollar. 100 rupee per dollar. You can convert into dollars. How will you convert? Divide by 100. Divide by 100. $15.2 is the issue price per GDR. 15.2 is the issue price per GDR. Compute cost of GDR. Now, how will I calculate cost of GDR? Is very simple. K is equal to T1 P naught minus F plus growth rate. This entire calculation, you can do it in dollars, you can do it in INR, final answer will remain same. One GDR is equal to how many shares? 5 share. Last year, dividend per GDR is 100 rupees, 5 into 20. Last year, dividend per GDR is how much? 5 into 20, 5 into 20, 100 rupees, 5 into 20, 100 rupees. What is the growth rate? 10%. 100 plus 10%. I wanted to issue GDR. Ideal issue price of the GDR. Ideal issue price of the GDR is ideal is 1900, but I want to issue it at 1520. 20% discount I want to give. I think there should have been a flotation cost also. Let me just see the solution. Yeah. It's missed in the question. 5% flotation cost is there. Okay, it got missed out in the question while typing. 5% flotation cost is also there in the question. Minus 5% of 1520. 76. It got missed out in the question. Okay, plus growth rate 0.10. This will be the cost of GDR. Cost of GDR. Can I do it in dollars? Divide your numerator by 100. Divide our denominator by 100. That is dollars. Keep it in rupees. Keep it in dollar. That's your wish. Any doubts on this? You get some 17.62%. There was that typing mistake. That's okay. 5% flotation cost is there in the question. Any doubts on this? I'll repeat again here. Concept is very simple. Infosys India wants to raise money from US investor. They like my company, but they are not ready to invest in Indian currency. So I deposit with maybe a custodian bank, issue shares there. Issue shares means issue ADRs there. It is listed there. I have to comply with whatever listing provisions are there, declare results, everything I have to do. So I have to declare results. I have to comply with all the provisions of the US regulators. Trading will happen. Dividend declared. Dividend will be passed on there. Clear? Able to understand this? Done. So for calculating issue price, you will have to know one, what is the ratio, and is there any discount you want to give, and is there any flotation cost. We'll do a problem around this in some time. Any doubts on this? Done. Okay, let's take a 10 minutes break. Okay, we were doing this GDR part. Let's do a question around GDR. Let's come to question 22. X Limited is interested in expanding operation, planning to install a manufacturing plant at US. For the proposed project, it needs 10 million US dollar. Net of issue expenses are flotation cost. Estimated flotation cost is 2%. To finance this project, it proposes to issue GDRs. Following information: expected market price of share at the time of issue of GDR 250, face value is 100 rupees. This is in institute study material there in chapter 11, which is your international financial management, but it's more of a security valuation question. 2 shares will underlie each GDR, shall be issued at 10% discount to market price. Expected exchange rate 60 per dollar. Dividend 20% with a growth rate of 12%. Compute the number of GDRs to be issued. Cost of GDR. What is your suggestion if the company can receive from a US bank a loan with an interest rate of 12%? How much company can save by choosing the option as recommended by you? Quickly go through this. Similar question would be there in my earlier material, but numbers would have changed. I've copied exact numbers of institute study material. Some questions I have changed where I've copied exact numbers of institute study material. Just to, because then student solves my material, then he solves institute study material. I didn't want that headache. So exact numbers I've copied now. Okay, let's discuss this. I am in need of $10 million and there is an expense of 2% of flotation cost. One GDR is equal to how many shares here? 2 shares, and I plan to issue it at a 10% discount to the market price. Let's start writing it. Computation of number of GDR. Computation of number of GDR. Particulars. Calculation amount. Calculation amount. Point number 1. Share GDR ratio. Share GDR ratio. The ratio given is 2 shares is 1 GDR. 2 is to 1. Share GDR ratio 2 is to 1. Point number B. Current market price of share. Current market price of share. The current market price of share is 250 rupees. You add a word rupees here. Issue price per GDR. Issue price per GDR 2 into 250 minus there's a discount I want to give. How much? 10% discount. Rupees 450 OR. Rupees 450 R. What is the exchange rate given? Divide by 60. One GDR will give me $7.5. One GDR will give me $7.5. Question wanted number of GDRs to be issued. I'll get $7.5 from one GDR. Point number D. Net money to be raised. Net money to be raised. How much money we are planning to raise? 10 million, which is 1 crore. USD 1 crore. This is the net money. There is some expenses. Now, if you want to raise 1 crore, what is the expenses they have said? 2%. I have to raise more than 1 crore. And it's not directly adding 2% and all. You will have to do a little bit of a calculation. 1 crore is what the net money I want to raise. Net money is 1 crore and expenses is 2%. Point number E, gross money. Gross money to be raised. Now listen, expenses is 2%, expense is on the gross money. So gross is 100, net is 98. Gross is 100, net is 98. In short, 98 equal to 1 crore, what is 100? If the issue expense was on the net amount, the net is 100, gross is 102. Net is 100, gross is 102. Here gross is 100, net is 98. Small variation will come in answer. Gross 100, net 98. Other option, net 100, gross 102. Which will happen if the expenses was on the net amount, Normally expenses is on the gross amount, So 98 equal to 1 crore, 100 equal to question mark. We will raise some 1 crore, 2 lakh something. 1 crore, 2 lakh, 4,082. Any doubts on this? This divided by 7.5 is the number of GDR. This divided by 7.5. One GDR will give me $7.5. One GDR is at $7.5, and I want to raise 1 crore, 2 lakh, 4082. Any doubts on this? You cannot directly add 2%. Some students make mistakes around it. Okay, 1 crore 2 lakh 4082 is the gross amount to be raised. Divide this by 7.5 per GDR. Divide by 7.5. Any doubts on this? Number of GDR. Number of GDR 102,04082 divided by 7.5. 13 lakh 60,000. This is part 1 in that first requirement. There were 2 requirements in part 1. How many GDR we are going to issue? 13 lakh 60,544. Any doubts on this? Can you proceed? There's another way to get this also. 1 crore divided by 7.5. 2% subtract here because you are not going to raise 7.5. Net amount by net price, gross amount by gross price. Net amount by net price, gross amount by gross price, both will give same answer. Small rounding of difference can be there. 1 crore divided by 7.5 minus 2%. What is 2%? 2% is the flotation cost. 7.5 minus 2%, you can put it in the denominator, or you can do 1 crore 2 lakh 4,000 divided by 7.5. Any doubts on this? Can we proceed? Clear? Cost of GDR, KGDR, technically KE. KGDR is KE. Cost of GDR, D1 P0 minus F plus growth rate. P0 minus F plus growth rate. D1 by P0 minus F plus growth rate. Can you proceed? What is the dividend the company is going to pay? 20% on face value. 20% on face value. Dividend expected to be paid is 20% with a growth rate of 12%. I assume this 20%, whatever they are paying, is D1. Somebody says it is D0, then you have to add growth on top of it. I'm assuming this to be D1. 20 rupees, because face value is how much? 100. 20 rupees per share, 40 rupees per GDR. 20 rupees per share. 1 GDR is equal to 2 shares. 1 GDR is equal to 2 share. 20 plus plus or 20 into 2. So this is 40, 450 minus 2% of 450. Growth was how much? 12%, no? I've got the answer in live online. You get answer is how much? I'm assuming the dividend expected to be paid as D1. Yeah, 21.07%. Any doubts on this? Clear? Able to understand this? 21.07% is the cost of GDR. The cost of GDR is 21.07%. Any doubts on this? Can we proceed? Share also can be there whenever you issue a new share. The problem which we have done, we have not made a new issue. If you issue new shares, Lenskart has issued shares, they would have incurred prospectus cost, they would have incurred the merchant banker cost, underwriting cost. So whenever you make a new issue, there will be flotation cost, and KE formula is D1 by P0 minus F. Minus F is there also. Flotation cost was not there in any of the problem which we have done till now. This question, flotation cost is there. Both. At interlevel you would have done D1 by P0 minus F only. Minus F only. Minus F is there even for cost of equity. It's there for cost of GDR. Minus F we have not done in any question because you did not see flotation cost in any of the problem till now. If it is there, it will come in both the places. Clear? Can we proceed? What is your suggestion? If you can get a loan at the rate of how much? Take the loan. How much savings will we have? 9.07%. 9.07%. 9.07%. If loan is available at 12%, take a loan at 12%. Saving is 9.07%. Technically, the second and third part is not a right question. Reason is you cannot compare a loan with an equity, because equity means business not doing well, I'll not pay dividend. Loan means whether doing well, not doing well, you have to pay. So that is why SBI FD is at 7%. SBI equity is at 14%. Reason is they risk is different for an investor. Technically both are not comparable, but they have done comparison and said you are making a saving of 9.07%. So 12%, please take it and you will save 9.07%. Any doubts on this? Can we proceed? Done? Able to understand this? Any doubts on this? Okay. In that step up growth model, the multiple step up growth model, we saw a question where price was to be calculated. We saw a question where growth rate was to be calculated. We saw a question where dividend was to be calculated. And there's another question where cost of equity itself is to be calculated. Cost of equity itself is to be calculated. What happens there is what we are going to see in concept 26. Cost of equity itself is missing in the question. Now, the formula for KE we follow is what? D1. But when I use this, I ask you what is the growth rate, you start giving me two different answers. You say 10%, 12%, 14%, 16%. I cannot use this formula. I cannot use the formula till you give me a single growth rate, and you will give different growth rate. You will give different growth rate. Cost of equity with multiple growth rate. Direct formula of concept 9 cannot be used as growth changes. Then what are we going to do? We are going to follow an approach called IRR approach. How does it work? You will understand as we proceed with the discussion. So we have seen earlier calculating price, calculating dividend, calculating growth rate, and now KE itself is missing. Take the current market price as outflow of the investor, assuming we buy it today. I go and buy the share today. Whatever I pay today is my outflow. Compute dividends till the stabilization phase. Dividends you can calculate. How will you calculate dividends? Base dividend is given, growth rate is given. Take terminal value based on perpetuity valuation. What is perpetuity valuation? P7 is equal to D8 by K minus G. P8 is equal to D9 by K minus G. Discount above and compute NPV. If you get exact 0, it means that is the rate which is investor earning. IRR, if you get NPV 0, NPV 0 means IRR is equal to that rate. That is the rate investor is earning. We are calculating what investor will earn. IRR of the investor is cost of equity of the company. IRR of the investor is cost of equity of the company. More clarity on this will come as I proceed with the problem. There is one good example which is there here, and a question is there in institute study material. I'll do the question of institute study material. Example, you will do it at home. Both are same. My MCQ will be lesser, 2 years or 3 years data. Institute study material question will have more number of years. I'll explain again. Here, I am not giving you KE. I am not giving you KE. So if KE is not available, I will have to calculate IRR of the investor. How will I calculate IRR of the investor? I buy the share today by paying the price given in the question. First year get dividend, second year dividend, third, fourth, fifth, sixth, till it stabilizes. And there is a price. Discount it at KE. What is the KE? You will assume some rate. You will have to assume one only. So you may assume 5%, 10, 15, 20, 25, 30. In my MCQ, when you do, I have told 22 and 23. So some table has to be given below the question. Use 22 and 23, some rate I have told. So I'll follow one rate, get NPV. Positive NPV. Answer is your IRR is very close to it. I need one positive NPV, one negative NPV. How we do IRR and all, I'll not spend time now. That I'll spend when I go to capital budgeting, because IRR is discussed there. But I need one positive NPV, one negative NPV. Understood the concept till now? We have seen question where price is to be calculated, growth rate is to be calculated, dividend is to be calculated, and now comes a scenario where cost of equity itself is to be calculated. Go through 23 and complete part 1. I'll come to part 2. I'll do only part 2. 2 minutes for you to complete part 1. Part 1 you complete it. I'm not even explaining it. I've started getting answers in live online for that. I think here also we should have done. What's the answer? 17.6. This is very simple. 1 rupee plus growth rate is 12%. 1.1 to D1. P naught is 20. Growth rate is 12%. You got 17.6%. This should be self-explanatory, easy to understand. Can we proceed? Instead of the situation in part 1, dividend will grow at 20% for 5 years and 10% per year thereafter. What is firms expected or required? Required return on equity is cost of equity. Okay, part 1 was also cost of equity only. When you have single growth rate, D1 by P naught plus growth rate, or D1 by P naught minus F plus growth rate. But now comes the headache. They are saying 20% for 5 years, 10% per year thereafter. What we will do is we will write year, cash flow, PVF, DCF, PVF at a random rate. What random rate? We got 17.6. I'll try 18%. I get positive NPV. Increase it to 20. I get negative NPV. Reduce it to 16. 18 is what my start will be. Why 18? 17.6 we got earlier. Okay. What are we going to do? Year, cash flow, PVF, DCF. Year 0, I buy the share. Year 1 dividend, year 2 dividend, year 3 dividend, year 4 dividend, year 5 dividend. At the end of year 5, P6 by D6 by K minus G. Clear? Able to understand this? We will get NPV. Positive, great. Negative, then you will have to increase, decrease. Exact 0 you are getting, best. Exact 0 I get, answer is over there itself. Exact 0 we may not get. Any doubts in this? Any doubts in this? Now write computation of IRR. Computation of IRR. Computation of IRR in bracket cost of equity. Have space for 8 columns. 4 columns we are opening now. Have space for 8 columns. Okay. Year, cash flow, PVF at 18%, DCF. In Excel, if I do it, I can use a function called goal seek. It will give me exactly the answer 18.5, 6, 7, 8, any number. Directly I'll get it. In your notebook, you need one positive NPV, one negative NPV. How IRR is calculated, formula and all, you may be aware. You have done it at Inter also, but I'll spend time when I go to capital budgeting. Year 0, I buy today. What is the price? Minus 20. Minus 20. First year, last year dividend was 1 rupee. What is the growth rate now? They said 1 plus 20%. 1.2. 20% is the growth rate. Year 2, again what is the growth rate? 20%. Year 3, 2 decimal, let's keep it as 2 decimal. 7, 3. Year 4, 7, 3 plus 20%. Year 5, 2.49. Any doubts on any of the numbers here? Again year 5. D6 by KE minus G. D6 by KE minus G. What is the growth changing from 20 to 10%? 2.49 plus 10% divided by KE. I have taken it as 18. My assumption is it is 18. Later on we will increase or decrease the KE. As of now we are taking it as 18%. 18 minus 10%. 18 minus 10%. 34 point. Any doubts till this? That's all. No writing beyond this. Okay. I don't want you to write. If you have understood till this, it is over. Calculation, I don't want to waste time now. Any doubts on this? Any doubts on this? First year dividend, second year dividend, third year dividend, fourth year dividend, fifth year dividend, and at the end of fifth year, perpetuity valuation. If we get positive, we increase or decrease. Listen, when you do revised NPV, revised 19 or 20, this number has to be calculated again. Year 5 number again. Year 1 dividend will remain same. Second year, normally whenever you do any revised NPV, cash flow remains same. In a capital budgeting problem, year cash flow PV of DCF, same cash flow, again another PV of DCF. But here, year 5 number, denominator can become 19 minus 10, 20 minus 10, the values will undergo a change. Any doubts on the calculation till now? Beyond this, be in lesson mode. I did all these numbers. Some rounding of differences can be there. Let's not worry about it. We got. I've done it little differently here. Let's not worry about. NPV is going to be 0.29. Okay. When you do calculation at home, you'll find NPV as 0.29. NPV will be 0.29. What is? Or let's do it here. Let's do it here. Do 4 decimal. Presentation is little different here. 1 divided by 1.18. 4 decimal they have told. 8475, then 7182, then 6086, 5158, 4371, and again 4371. You'll have to multiply this. 2 decimal, we will keep it here post multiplication. 1.02, 0, 3, 05, 07, no, it looks 0, 9, 14 point. I'm just going by the numbers you're giving. Tell me the total NPV. Printed answer, I've done it little differently. I think this is easier. Final answer 0.23. In the printed answer, it was 0.29. Okay, 0.29, 0.23. That's rounding of difference. Any doubts on 0.23? We have got positive NPV. We'll increase it. We will increase it. Increase it to what rate? 20%, 19%. Any number I can take. I'll increase it to 20%. I'll increase it to 20%. When I increase it to 20%, here that 20, 1.2, all that will not change. Perpetuity alone will change. 3 more columns. Cash flow, I told you 8 columns. Cash flow, PVF at 20%, DCF. Cash flow, PVF at 20% and DCF. We have already done one NPV. We got positive. I'm increasing. Solution, I would have increased it to 19. I don't know, whatever I've done. I want to do 20 now. Any number you can take. 1% also is fine, but I've increased it to 20%. Till 5 years copy paste. Last year alone will change. Last year will change. Denominator is 20 minus 10. 27 point. Discount it now. You will get a negative NPV. You will get a negative NPV. Printed answer, we have done 18 and 19%. 18 and 19%. Net net, the final conclusion, everything remains same. The logic is the same only, but here I've done 18 and 19. In class, we are doing 18 and 20. Do the same thing. 833 6944 5787 4823 4019. When you multiply minus 20, it will exactly be 1. You should get exactly 1 mostly. All the 5 will be 1. And last year is 11.01. This will give obviously negative NPV. This will give negative NPV, 1 positive NPV, 1 negative NPV, IRR will be calculated. So we have seen all possibilities now. We have already seen one possibility of growth, one possibility of your dividend, one possibility of price computation, and the last possibility is KE itself. KE itself. Only thing is KE is more time consuming. KE is the most time consuming. Reason is you need one positive NPV and one negative NPV. Any doubts on this? What is the NPV you get? Okay, 3.99, negative 3.99. Any doubts on this? Any doubts on negative 3.99? Can we proceed? Any doubts on negative 3.99? Now, right, IRR is equal to, as of now, whatever I say, you please write it. Formula, everything I'll discuss there when I go to capital budgeting. L1, NPV at L1 divided by NPV at L1 minus NPV at L2. I will not expect you to remember this formula. I'll explain logic there, okay? Into L2 minus L1. When I go to capital budgeting, we will discuss it. Into L2 minus L1. L1, NPV at L1 by NPV at L1 minus NPV at L2 into L2 minus L1. L1 means lower rate, 18. 18. What was the NPV at 18%? Divided by 0.23 minus of minus 3.99 into L2 means higher rate, L1 means lower rate. Broadly, the number will match. Some variation can be there because we took 18 and 20. Solution is 18 and 19. 18.11%. All possibilities seen. This is what, if at all step up growth model is tested and they want to twist, they can twist in multiple ways. Any doubts on this? Can you proceed? Able to get clarity on this? Any doubts? Done? Printed answer is also same thing, but slight up and down variation I have done. Any doubts on this? We have done till concept 26. I go back to two concepts which are pending, I think 2-3 concepts pending. P multiple approach. An approach which doesn't need any major discussion. As you are aware, P multiple is EPS into P multiple is the fair price. P multiple can be given in question. Great. If not given, there are two ways of calculating P multiple. If you are doing 100% payout, P multiple is 1 by cost of equity. P multiple is 1 by cost of equity. Another approach, which is not a very logical approach, is 1 by return on equity. What is return on equity? Is EPS by BVPS. Inverse is BVPS. So the second approach is followed if you make this assumption. Book value and market price is same. With that logic only we are going to do. Book value and market price is same. P multiple ICI takes us 1 by ROE rather than 1 by cost of equity. With the logic is book value per share is equal to market price per share. Book value per share is equal to market price per share. They may not give it in the question, but this is the logic. They'll be doing 1 by ROE, 1 by ROE, return on equity, 1 by return on equity. ROE 8%, P multiple 1 by 8%, P multiple 1 by 8% into EPS is the fair price, is the fair price. Under P multiple approach, 1 by return on equity. What is the logic for return on equity? ROE is EPS by BVPS. Inverse is BVPS by EPS. Logic is BVPS is equal to MPS, and which is what we are calculating. We are calculating. Any doubts on this? Any doubts in this part? Can we proceed? Because P multiple is MPS by EPS. Here ROE inverse is BVPS by EPS. This is one approach. Along with that, they may ask an approach called earning growth model. Ideally an approach not to be used, but sometimes question may ask. What is earning growth model is D1 by KE minus G. Don't use D1, use E1. E1 means earnings of the first year. Earnings of the first year. Instead of using dividend, you will use earnings of the first year, which is called E1 divided by KE minus G. E1 divided by KE minus G. We normally use D1 divided by KE minus G. Here we are going to use what? E1 divided by KE minus G. When will we use? Question specifically may tell use earning growth model. Clear? Any doubts on this? Any doubts on this? This has also got tested in exam. May 25 exam. Given the following information, current dividend 2.5, discount rate 10.5%, growth rate 2%, calculate the present value of the stock. Is the stock overvalued? If the price is 35, ROE 9%, EPS 2.25, applying P multiple approach, earning growth model. Original part, they have not told the model. Our normal model, which is D1 by KE minus G. D1 by KE minus G. Let's start. Question 24. P naught is equal to D1 KE minus G. D1 by KE minus G. $2.5 plus 2%. I've got the answer in live online. Answer they have told is 30 rupees. Any doubts on this? Straightforward, simple calculation. 2.5 plus 2% divided by 10.5 minus 2%, 30 rupees. Clear? Can we proceed? Second part is, there is technically no linkage between part 1 and part 2 of the question. Ideally, they could have made it as a separate question itself. I don't know why they made it as a single question, and this leads to some challenges also. When you do, you'll understand. Now write P multiple approach. P multiple approach, EPS into P, EPS into P. What is the EPS given? 2.25. P multiple is 1 by return on equity. 1 by return on equity. 1 by return on equity, because ROE is given only for that purpose. So indirectly the assumption is book value per share is equal to market price per share, and that is how this formula is derived. 1 by 9%, 2.25, P multiple is 1 by 9%, which is 11.1111, and if you multiply you get 25. Till this also I have no problem. This is also okay. The biggest headache is going to be earning growth model. Earning growth model will have a headache. Any doubts till this? Clear? It's a study mat question, so you be aware what we are doing. Some places, some questions alone, I've been telling you certain points where debatable answers are there. We'll try to follow ICI solution to the extent possible. Any doubts on this? Next, earning growth model. E1 KE minus G. What is the EPS given in the question? E0, very clear word is E0, 2.25 plus, how much is the growth rate? 2%. What is the cost of equity? 10.5. ICI unfortunately did not award marks to a student who did this. 10.5 they have not followed. Rework scenario, they have taken ROE as KE. I don't have logic and all, don't ask me logic for that. But rework scenario, they did this in one MTP. In one MTP they did this, but very clearly mentioned in the question, use 10%, use 9% to calculate earnings growth model. They did this in one mock test paper, and in this question in bracket they said use 9% as KE. What is that 9%? Return on equity. I have no problem if you clearly mention this way. So one student, I think when it came in May 25 exam, they had sent the paper to me. They had followed 10.5. Unfortunately, marks were not awarded. Debatable item. I do not have a logic around it. Okay, some questions this challenge will be there. Good part is 30 marks of MCQ. Confusion will not be there. On the descriptive side, some challenges can come in few questions. They have used KES 9%. They have used KES 9%. You can complete the answer. It is assumed ROE is the cost of equity for the rework scenario. Usual assumption taken by ICI, same is debatable. Same is debatable. I hope they continue with the same assumptions if it comes in exam, or in case time permits, you give two answers. Two answers will not take much time. One assuming the KE to be the original KE. Second, assuming KE changes based on ROE and it becomes equal to this number. The stock is valued, I think, in the question at 35. We got 25 and 32.79. Stock is overvalued in the market. Stock is overvalued. The model has no difficulty. Formula has no difficulty. Only challenge is the interpretation part, which is little bit of an issue here. Any doubts on this? Can we proceed? Any doubts on this? Done? Let's come to 25. Go through the question for a minute. Okay, Mr. A is thinking of buying shares at 500, having a face value of 100. He is saying some bonus will come in the ratio of 1:5. Dividend is 20%. Same will be maintained on the expanded capital base. He intends to sell the shares at the end of 7th year at a price of 900. Incidental expense for purchase and sale. He expects a minimum return. Minimum return of 12% is KE. Minimum return is KE. Should Mr. A buy the share? In order to decide whether I should buy the share or not, I have to calculate the fair price. How will I value the share? Present value of future cash flows discounted at investor required rate of return, technically Gordon's formula. They make it more simpler for you, saying that I'll give you first year dividend, second year dividend, third year till 7th year, and at the end of 7th year you don't take any effort, I'll give you the price also. At the end of 7th year I'm giving you price also. What is the price given in the question? 900. Only thing is, when I sell it, I have to incur some expenses. So I may not get 900, I may get little lesser. So what we are going to do? Year, cash flow, PVF, DCF. In class, you will write year end cash flow. PV of DCF, we will not do now onwards. You will write year end cash flow with me. PV of DCF, we are not going to waste time. I'll tell you the total from the question itself. Clear? Able to understand this? Let's start. Year cash flow PV of DCF. You need not write the PVF and DCF column, okay? Heading you can write, but you are not going to fill it. Year cash flow PV of DCF. What is the dividend the company is going to pay? 20% on face value. On face value. First year 20, second year 20, third year 20. There is some bonus paid. When is the bonus paid? During the fourth year. I had one share. Now one share will become 1.2. Decimal not possible, but let's assume decimal is possible. I may not be buying one share, I may be buying 100 share. 100 would have become 120. Bonus is in what ratio? 1:5. So my 1 has become 1.2. On this 1.2, I'll be getting 20 rupees either from the fifth year or from the fourth year itself. It all depends on when is the bonus made and when is the dividend declared. This I had touched upon one mutual fund question saying that whenever a bonus or a rights issue is made, on that bonus share, you may get dividend, you may not get dividend. Your one share has become 1.2 during which year? During the fourth year. I assume fourth year I get on 1.2. On 1.2. How 1 became 1.2? 1:5. There is a bonus in the ratio of what? 1:5. So 1 share has become 1.2 share and 1.2 into 20 rupees per share. Year 4, 24. Year 5, 24. Year 6, 24. Year 7, 24. What is 24? Is 1.2 into 20. 1.2 into 20. I purchased one share. It increased to 1.2 share. Any doubts on this? At the end of 7th year. At the end of 7th year, I'll sell the share. What is the selling price? 900. Now listen, you will not be selling one share. You will be selling 1.2 share. You will be selling 1.2 share. This you have to be aware of. Why 1.2? Some bonus got declared in between. 1.2 into 900. Some incidental expenses are there on purchase. 5% of the market price. Incidental expenses are 5% of the market price. 1.2 into 900 minus 5%. 1026. Your work is over now. Now onwards, only listen mode. Any doubts on any of the numbers here? Any doubts on any of the numbers? Yes, purchase both. Purchase as well as sale as well. It says incidental expense for purchase and sale is 5%. Purchase 5%, sale also 5%. Purchase part I'll explain in some time. As of now, we have done the sale. Any doubts on this? What is the required return of the investor? 12%. We are not doing beyond this. You will not do. Okay. PVF at 12%. This will unnecessarily take a lot of time at your end. 1 divided by 1.12. We will do DCF. This is the fair price of share. 563.68. 563.68 is the fair price of the share. Now, after 563, you will write along with me, okay? Then write maximum purchase price, right? Maximum purchase price. Maximum purchase price plus transaction cost is 563.68. Price, I will have to buy, pay cost on that. Put together, I can pay 563. Put together. What is put together? Purchase price as well as transaction cost. I am incurring transaction cost on purchase as well as on sale. If somebody say it is available at 550, don't give answer 550, 563. You cannot compare that way. 550 on that I have to pay 5%. If I pay 5% on 550, it will go to 580 or 590. it will be a bad purchase. So purchase price plus the transaction cost is 563. Purchase price is A. Transaction cost is 0.05A. Purchase price is A. Transaction cost is 0.05A. 5% transaction cost you have to incur. Put together, I can pay 563. Why? I am getting 563. I will pay 563. Getting 563 from the share, paying 563 for the share. Any doubts on this? Tell me the purchase price. And question says it is available at what rate? 500. I'm happy to buy at 500. I'm happy to buy it. You cannot give answer directly with 563 and 500. 536 and 500 is comparable. Should Mr. A buy the share? Yes, he can buy. What maximum price? 536.84. 536.84. Why 536? Because including the transaction cost, I will pay 563.68. Any doubts on this? Able to understand this? Clear? Can we proceed? I'll explain again. My inflows total is 563. In a normal scenario, max purchase price is 563. In a normal scenario. But here purchase price plus transaction cost is 563. Purchase price plus transaction cost is 563.68. Any doubts on this? Can we proceed? This is where two concepts were there. Now this question I thought I'll do problem first and then concept. Impact of bonus on terminal value. Whenever a bonus is declared, what is terminal value? Is last year value. Whenever a bonus is declared, be careful. Sale proceeds is higher number of share into selling price. What is higher number? 1 became 1.2, 1.5, 1.8, 1.9. To take that higher number of share and then multiply with the selling price. One share can become 1.2, 1.5. Whatever we did is the same example here. Okay. Second part is maximum purchase price, no transaction cost, maximum purchase price 563. No transaction cost, maximum purchase price 563. If it is there, 563 divided by 1 plus 0.05, which is what you would have done. It is the same formula only we have done. I told you in different way, 536.84. If you are going to pay a transaction cost, maximum purchase price is not equal to the price we calculated or the present value we computed. Any doubts on the concept here? Clear? Two concepts are there for only one single question. You have to divide by 1 plus transaction cost. No transaction cost, 563 is the maximum purchase price. Any doubts in this? Can we proceed? Clear? With this, my discussion on step-up growth model fully over, P multiple approach fully over, your earnings growth model fully over. There are, I think, one more model and maybe two more discussion is needed. One is called FCFE approach, which I'll explain as we proceed. Any doubts till this? Any doubts on this? Once I'm done with entire equity part, we will revise entire equity. Then I go to the next part. When I go to the next part, we will forget equity. That's all. Equity is like a separate chapter itself. Just give me a minute. If there's any other question, let me see. Okay, I had told you to go through those ratios part. If you have gone through it, it will be easier whatever questions I'm going to discuss now. If you have not gone through it, I cannot really help it. My explanation, I may do little bit only, or I may not do even the explanation. Format of income statement, it starts with sales, deduct cost of goods sold, you get GP, deduct operating expenses, you get operating profit, which is called EBIT, deduct interest, you get EBT, deduct tax, you get EAT, deduct preference dividend, you get EAES, number of equity share, EPS. How interest is calculated? Problem silent, respective debt into the respective interest rate. Problem gives effective interest rate, total debt into effective interest rate percentage. How is this making a difference? If at all you had solved the MCQ, you would have seen this at home itself. You see this example, 8% debenture, 125, 10% bond, 50. How do I normally calculate interest? 125 into 8%, 50 into 10%. Question says effective interest rate is, so ICI said add this and directly do into 8%. ICI said add this and directly do into 8%. In fact, in one MTP, they have given this as a MCQ question and they have asked if 8% is the effective rate, when was the bond issued exactly? April, May, June, July, August, something like that. They have asked it. It is there in my MCQ question. You see that later on, okay? But they asked exact period when the bond was issued, because your interest outflow is not for the full year. Interest outflow is for the part of the year. 10% if you pay one full year. 8% if you pay, 10% equal to 12 months, 8% equal to maybe 10 months or 9 months, something like that. They had asked this as one MCQ question. Any doubts on this? Interest calculation, normally what you do? Interest rate into the debt plus interest rate into the debt. But if they give you single effective tax rate, effective interest rate, you can add up the overall debt and multiply with this. I 100% wanted you to do this MCQ and this concept. You will then only appreciate. Otherwise, this discussion may go above your head. I cannot really help it because I don't want to spend time on this area. Purely CA inter area. We'll be doing a question on this. These are important ratios. Unless you have grip on this, you will struggle in. I may use ratios in some 30-40 question. Suddenly I'll say debt equity ratio, suddenly I'll say debt ratio, suddenly I'll say equity ratio, suddenly I'll say asset turnover ratio, inventory turnover ratio, COGS ratio. This entire category, I don't want to rush through and explain it. It will not go on your head. So I am not explaining important ratio. I've already told you. Unless you have a doubt in any ratio, you can tell me. If at all any category at home when you saw, if you found it difficult, let me know. I'll explain that category. If you live online guys also, if you have found any category difficult, I will explain. If you have not gone through it, I cannot really help it. This category I wanted you to see purely CA inter. If anything of CA final is there, I can explain. Clear? Can we proceed? Any category you want me to discuss, then let me know. There were terms like capital employed, all this done at CA inter. You should have ideally understood it. I'll be discussing this suddenly in business valuation, suddenly in derivatives, suddenly in maybe in mergers and acquisition. We have already discussed some of these ratios. Portfolio we may discuss. If any doubt is there in any category, let me know. I've not got any points from live online guys, which means I assume you are okay with all the category. I'll come back to that one concept which is pending is FCFE approach. But before that, let's come to question 30. This is already done by you as an MCQ, okay? Already done by you as an MCQ, but it's the same question here. If you have done the MCQ, you would have found this question there also. Question 30, let's look at. Following information are available for PQR Limited for the year 2008. 8% debenture, 10% bond, equity shares, reserves and surplus, total asset, asset turnover ratio, effective interest rate, tax rate, operating margin, dividend payout ratio, current market price, required rate of return on share. You are going to do major chunk of it. Draw an income statement. What is income statement? Sales less COGS, if COGS data is there, or less operating expenses, EBIT less interest, EBT less tax, EAT less preference dividend, EAES number of equity share, EPS. Sustainable growth rate, ROE into retention ratio. Growth rate is ROE into retention ratio. What is ROE? EAES by amount of equity. Retention ratio 100 minus payout ratio. Fair price using dividend discount model. Discount model is Gordon's model, D1 by KE minus G. What is the KE? KE is given in the question. What is the KE here? Required rate of return of investor 15%. And what is your opinion on investment? You do the income statement, you do everything. I'll give you around 6 minutes. You start doing it after 6 minutes. I'll do it in the screen. Okay, 6 minutes for you to do this now. Okay, you keep doing it. I'm now doing it in the screen. You can check it in case you want. I had to do an income statement. I'll keep explaining and doing it. Particulars amount. Sales will be calculated through a ratio called asset turnover ratio, which is sales by asset. Sales is asset turnover ratio into total asset, 1.1 into 600. If a student is not aware of this ratio, problem is over for you in the first step itself. You would write wrong sales, the problem gets over there itself, nothing else to be done at your end, entire solution will go wrong. Minus expenses 660 into 90%. Operating profit is 10%, 90% is expenses, 594. Operating profit is 66. Interest, if the effective interest rate was not given, 125 into 8, 50 into 10. Maybe because it is given, somewhere it is in between. So this interest number comes out to be 125 into 8, 50 into 10. What's the number you get? Sorry, not 175 into 8. 175 into 8, 14. 52 is PBT. Taxes, which is 20.8. PAT is, EPS is 31.2 divided by how many shares are there? 10. EPS is 3.12 and dividend is 0.52. Dividend is 0.52. Any doubts on this? Any doubts on this? Initial part itself, you make a mistake, then it is gone, which is your asset turnover formula. ROE is equal to EAES by equity. EAES is 31.2. Equity is 100 plus 300, 7.8%. 7.8 ROE into retention. 7.8 into 83.33, 6.5%. Whatever dividend we have calculated, you can take it as D0 or D1. I don't have an answer to it. It is assumption. I'm not sure what is there in the answer. Any doubts on this? I think problem is over for me. Any doubts on this? Your fair price is 0.52 taken as D0 plus 6.5% growth rate divided by 15 minus 6.5%. Somebody wants to say, no, this is D1. Go ahead and take it. That's your wish. I have told what does I say answer here. Time permits an exam. Give two answers wherever confusion is there. If there was a consistency in ICI solution, I would have told this is what they will follow. Consistency may not be there in many questions. Any doubts on this? Can we proceed? This entire question is extremely simple if you are aware of ratio analysis. If you are not aware of ratio analysis, entire solution will go wrong. Again, I'm repeating, in the categories of ratios, if at all you want me to explain any category, last time I'm asking, any category, if you have not got clarity, you can let me know. Else I proceed ahead. Good MCQs were there below that. Ideally, if you had solved it, you would have got the required grip to face the exam. Any doubts? Can we proceed? Clear? Capital gearing ratio. This entire capital structure or the only capital gearing? Okay. What is capital gearing ratios? Capital structure basically means composition of debt, equity and preference. Capital structure means, in that we have all the 5 categories. Debt ratio, debt divided by debt plus equity. Capital employed means debt plus equity. Preference is not there for practical purpose in most of the company. Equity ratio, equity by debt plus equity. Debt equity ratio, debt divided by equity. Capital gearing ratio is another name for debt to equity ratio. Another name for debt to equity ratio. Only point in a capital gearing ratio is preference. If at all a question has preference capital, I used to work in a rating agency. Any company had preference capital, we will analyze the nature and either add it to debt or add it to equity. There are companies in the practical world which issue 0.01% CCPS. What is CCPS? Compulsorily convertible preference share. For all practical purposes, it is equity. Even I think your accounting standards may talk around it. But when I used to work in a rating agency, we used to take it as equity. Another company, 12% redeemable preference share. For all practical purpose, it is like a debt. We add it to debt. Practical world, companies will not issue preference capital like 12% and all. Reason is, if I issue it as debt, at least I get tax benefit on that. Why will I issue preference? Capital gearing ratio is the only ratio which says don't apply your brain and all and say preference is part of debt or preference is part of equity. Preference will always be added to debt. Preference will always be added to debt. The formula for capital gearing ratios: fixed charge bearing capital. Fixed charge means where you pay fixed amount. Interest is a fixed amount. Preference dividend is a fixed amount. So fixed charge bearing capital divided by equity. So I pay fixed interest, fixed preference dividend. That technically there is no difference between debt to equity ratio and capital gearing ratio. Practical world, preference you may not find in any company. Clear? Got any doubts? Any other ratio if at all you want me to explain? Any other ratio you need explanation, you'll have to tell me. Dividend yield ratio. Okay, there is an explanation needed on yield ratios. Now, yield as such, yield, okay, the formula is here. What is earned by what is invested. Yield basically means what is earned divided by what is invested. Dividend yield, dividend is earned, price is invested. Dividend is earned, price is invested. Earning yield, earning is earned, price is invested. Earning is earned, price is invested. Dividend yield, dividend by price. Earning yield, earning by price. Earning by price. Yield means what you earn by what you give. What you earn. Return on equity. Equity guys earn EAES, they give equity. Return on asset. Profit is earned, asset is invested. Return on capital employed. EBIT is earned, capital employed is invested. Same logic is dividend yield and earning yield. Dividend yield means dividend is earned, price is paid. Earning yield means earning is earned, price is paid. And opposite of this is dividend rate. Dividend rate is not there. Dividend rate is dividend per share by face value, divided by face value. Yield means divided by market price. Any other category, any other ratio you need explanation. To clarification, do we need to take preference dividend if not cumulative in capital gearing? We take non-current liability. Okay, there are two more doubts. The doubt which has come is, do we take preference dividend even if it's non-cumulative? Capital gearing, no brain application. Capital gearing means preference will form part of debt. Debt plus preference divided by capital employed. Debt plus preference divided by, debt plus preference divided by equity. No application, nothing, no extra thinking. Fixed charge bearing capital, whether dividend is cumulative, non-cumulative, whether it is a high dividend, low dividend. Second point is, do we take non-current liability in long-term debt? ICI for debt equity ratio or debt ratio has given multiple formula at CA Inter. The term debt can mean long-term debt. The term debt can mean long-term plus short-term. The term debt can also mean long-term, short-term, creditors, current liability, everything included. So it is an assumption based area. In practical world, again, I used to work in a rating agency. Our way of calculating ratio was different. Bank used to calculate ratio, their way of calculating ratio was a little different. Some variation will be there because formulas will be changed by people. Some people will prefer to take average numbers in the denominator. Some people will prefer to take only that year number in the denominator. So it can change based on people's way they look at. So whatever two doubts were there, I've clarified. If anybody else has any doubt, anybody else has any other doubt in the ratios, let me know. In case you need more clarity, there is a 12-hour video. I don't want you to see the 12-hour video, but if you open the 12-hour video, there will be something called a timestamp below that. In the timestamp, you will see me explaining each category of ratio. 20 minutes, 30 minutes will be every category. In the timestamp itself, you will find. If you have time, You need more clarity, you need to go through that timestamp, you will get clarity. CA Inter ratio analysis 12-hour video is there. Just look at the concept, no problem solving, all that is not needed. Clear? Can we proceed? Now, why are we focusing on ratio? Reason is, with ratio, I will do something called as fixed interest. So there is another doubt by Kavya. Fixed interest and fixed dividend, which I'm going to come to it. That I have not told you to look at. 30 and 31, I will be explaining now. I'll be explaining now. What is the purpose of calculating all this ratio? Purpose of calculating this ratios is, I want to value a company. You have told Walter's model, Gordon's model, you have told your P multiple approach. So many models of valuation is there. The best way of model of valuation is called customized model. Now, what is customized model? I am going to value a company with some subjective calculation. For example, I want to value TCS Infosys. TCS has a P multiple of 25 times. Okay. So I feel Infosys value should be EPS of Infosys into 25. EPS of Infosys into 25. This is my belief that EPS of Infosys into 25 can be the value of Infosys. Or cost of equity is 10%. TCS. I want to value Infosys. Walter's model or Gordon's model, I can use the KE as 10% and do the calculation. Beta is 1.2. Using that, you calculated KE. Whatever different ways are there. Now, if TCS has a P multiple of 25, then Infosys got irritated saying that why 25? I am better than TCS. You give me 26, 30, 35, 40. Or I am weaker than Infosys. Either I am better than Infosys or I am weaker than Infosys. If I am better than Infosys, better P multiple or lower cost of equity. Better P multiple or lower cost of equity. How do I find I am better or weaker? By comparing ratio. Impact of ratio on required return. Required return means cost of equity. If you are better than the competitor, your KE will go down. Your KE will go down. KE going down, value will improve. KE going down, value will improve. So an organization today, you want to value TCS, take Infosys data. Infosys P multiple will be there in the question, in the historical information. Take that P multiple, value TCS. You may see obviously a difference. TCS, I think, may have a better P multiple. Infosys can have a lower P multiple. Reasons? The various ratios. What are the ratios you can look at? Whatever is relevant. One ratio is growth rate. Growth rate is also a ratio only. Growth rate. Maybe I will look at net profit margin. I'll look at GP margin or an operating profit margin. Some pointers I will take and then adjust the P multiple. Our ratio is better than the industry. P multiple will improve. Required return will decline. Our ratio is weaker than industry. Weaker than industry. How much should you adjust? Your assumption. That is your assumption. If you are better, you will command a lower cost of equity or a higher P multiple. If I look at practical world, Infosys has a P multiple of 21. Okay, now it is almost same. Earlier TCS used to be on the higher side. TCS share price has gone down over the last few months. 21.5 to 21.81. The P multiple is same. Ideally, TCS earlier commanded a higher P multiple. Now, in order to compare this, which is better, which is weaker, I will take the help of ratios. I'll take the help of ratio, which is where ratio understanding is needed. So what we are going to do is capital gearing ratio of industry 0.75. What is capital gearing ratio? Debt plus preference divided by equity. My company equity share capital 100. So denominator is 100. My capital reserves and surplus is 150. Preference is 100. Debt is 200. My capital gearing ratio is 2 times. Industry is at 0.75. I am at 2 times. More borrowing is a weaker company. More borrowing is a weaker company. So I am a company which is weaker than the industry. I am a company which is weaker than the industry. If I am a weaker company, my cost of equity will be higher than the industry. Then they are saying Industry needs 10%. Required return is to be changed by 2 basis point for every 1 basis point deviation in capital gearing. You will see a question being solved where this is not written. You have to make assumption and proceed. But here in MCQ, I didn't want this headache. So what it means is industry is at 0.75. We are at 2. Weaker by 1.25. Extra KE 1.25 into 2 times. 2 basis point. Basis point means 0.02% for every 0.01% deviation. So my required return will go to 12.5%. My required return will go to 12.5%. Any doubts on this? Any doubts on this? I'll explain the logic again. I will calculate ratio. After you calculate the ratio, you have to decide you are better, weaker. Till this, we are on the same path. After that, if you have decided better, KE has to go down. Till this, no changes. How much to go down is a subjective call. How much to go down is a subjective call. Somebody will say one ratio better, add 0.5, deduct 0.5. Another ratio, add 0.5, deduct 0.5. 0.5 addition, 0.5 deduction. 20 ratios are there. Started with 10, added 0.5, deducted 0.5, deducted 0.5, deducted again 0.5, added 0.5, deduct. Like this, you keep going on. Ultimately, you'll get the KE for your company. You wanted to take 20 ratio. 20 ratio, that is a subjective call. Any doubts till this? So this is one point that I will compare. Now in this comparison, ICI has added one stupid ratio called fixed interest and fixed dividend coverage ratio. Technically, there is no ratio like this, but they themselves have added this in the exam question. In one mock test, when they asked, they gave this formula itself in the question, saying that you use this formula because it's not a logical formula. It is not a logical formula. Interest coverage ratio means EBIT by interest. Preference dividend coverage ratio means PAT by preference dividend. I cannot club both of them together. I cannot club them together, but they have given this, which is PAT plus interest divided by interest plus preference dividend. Again, not a very logical ratio, but let's not worry much about it. In case question says fixed interest and fixed dividend coverage ratio, you have to start with PAT, add back interest, denominator is interest and dividend. Coverage ratio logical formula is source of paying something divided by what is getting paid. My expenses coverage ratio is my income divided by my expenses. Your expense coverage ratio is your stipend income plus any pocket money you get divided by your expenses. Divided by your expenses. What is the source of paying something divided by what is getting paid? Interest is paid out of EBIT. Preference dividend is paid out of EAT. So technically both are separate. They said we will club it together. So they said PAT, add back interest because that is what you're going to pay, divide by interest plus dividend, divided by interest plus dividend. Any doubts till this? Any doubts on this? Can we proceed? Any doubts on this? My important point is if ratios are calculated, you can understand you are a better company or a weaker company. Better company, P multiple will improve, K will go down. Weaker company, P multiple will go down, K will go up. Clear? Any doubts till this? Can we proceed? Ideally, if I am doing valuation, I will try to follow this approach. And I will see every question you do, you write year, cash flow, PVF, DCF, everything is given in the question. Practical world, PVF for 10%, you have to justify why did you use 10%. You have to give an explanation. That explanation will be this, saying that industry is at 12%. I believe TCS is a better company, weaker company. Using all this logic, I feel it has 10%. You have to give justification. In exam, everything is given to us. We are just doing calculation. Practical world, how are you saying growth rate is this number? How is the cash flow coming? Everything has to be justified by us. Clear? Any doubts on this? Can we proceed? Let's do a question around this and then take a break. I'll do the question on this now. Go through 27. The entire equity valuation which we are discussing, it's like a separate chapter itself. Like M&A was completed, this is like a separate one full chapter. Okay, I'll start explaining. Capital structure of Sun Limited is given: equity, preference, debenture, reserve. Sun Limited earns a profit of 32 lakhs before deduction of income tax and interest. Before deduction of income tax and interest, which is EBIT. Normal return on equity share of TCS is 9.6. We are doing Infosys, let's assume. TCS is 9.6 and we are doing Infosys provided. So normal return on equity share means investors return company's cost of equity. Provided what? PAT covers fixed interest and fixed dividend at least 3 times. Capital gearing ratio is 0.75 and some definition is given on yield. Calculate value of equity share assuming 1% for every one time difference and 2% for every one time of difference in capital gearing ratio. What does this? You will understand in some time. First thing, we will do an income statement. In income statement, I will get some information and I will calculate two ratios: fixed interest and fixed dividend coverage ratio, capital gearing ratio. Once these two ratios are calculated, this 9.6 will be inflated or will be reduced, will be inflated or reduced. Now, if ICI really wants to test this question, instead of giving these two ratio, they can give some other four ratios. They can ideally do some other ratios and logic remains the same. Ideally, this is what ICI should do if they want to test. Instead of giving these two ratio, they can talk about asset turnover ratio or a GP ratio or an NP ratio. Anything can be asked on, and accordingly you will have to do the adjustment. Let's do income statement. Income statement. Particulars calculation amount. Start with EBIT. EBIT. How much is the EBIT given? 32 lakhs. Less interest. Interest is 6 lakh 40,000. Sorry, 64 lakh. No? 64 lakh into 12%. How much? 7 lakh? 68,000. EBT. EBT 2432. Less was the tax rate given? Tax is 35%. 2432 into 35%. 851 200. Sorry, this is not EBIT. EBT. EAT. EAT. How much? Less preference dividend. Less preference dividend. Preference dividend is 40 lakh into 8%, which is 3 lakh 20,000. EAES 12 lakh 60,800. Any doubts on this? Below this, I'll calculate those two ratios which they are talking about. The first ratio they are talking about is PAT covers fixed interest and fixed dividend, and second is capital gearing ratio. They have defined something as yield. I'll explain that in some time. Now, right, fixed interest and fixed dividend coverage ratio. Fixed interest and fixed dividend coverage ratio. PAT plus interest divided by interest plus preference dividend. 1580 800. Some students have asked why no after tax on interest. This formula itself is not logical, so we cannot build any logic around it. We just do this and then close it. 1580 plus 768 divided by 768 plus 320. Tell me the ratio answer. Live online student has told me 2.16. You can check and let me know. 2.16. Any doubts on 2.16? Now, if at all I wanted, I could have asked interest coverage separately, PD coverage separately. It would have made more sense. Next, capital gearing ratio. Capital gearing ratio, debt plus preference, equity share capital plus reserves. Debt plus preference, equity share capital plus reserves. I've got the answer in live online. Debt is how much? 64. Preference 40. Equity 80. 32. 0.93 times. Now we don't know whether we are better, weaker. We'll see. Any doubts on 0.93 times? The solution is almost done. Any doubts on 0.93? Adjustment in cost of equity. Adjustment in cost of equity. Cost of equity. You may need some 5-6 columns. I don't know the number of columns. 5-6 columns you keep it. Ratio, industry, our ratio, status, adjustment. Ratio, industry, our ratio, 5 columns should do. Status, adjustment. Our ratio, status and adjustment. There were 2 ratios they're talking about. Fixed interest and fixed dividend and capital gearing ratio. Fixed interest and fixed dividend. What is the industry ratio? The question is saying 3 times and 0.75 times. Our ratio, which we have calculated, is how much? Coverage ratio, higher the better. Unfortunately, we are weaker than the industry. Higher the better. Coverage ratio, we are weaker than the industry. Capital gearing ratio, lower the better. Again, weaker than the industry. Status, weaker by 0.84 times. This is also weaker by 0.18 times. We are weaker by 0.84 times and 0.18 times. If we are weak, we have to increase KE. If we are stronger, we have to reduce KE. How much to adjust? Question has told. If not told, subjective call. What question has? Any doubts on first these numbers? Question has said, if there is a difference in interest and dividend coverage, 1% for 1%, but capital gearing do 2% for every 1 time of difference. 2% for every 1 time of difference. So listen, increase KE by 0.84%. Listen for a minute. And this one, increase KE by 0.36. What is 0.36? Is double. I want to give double effect for capital gearing ratio, single effect for fixed interest and dividend. Any logic? Nothing is mentioned in the question. Practical world, some ratio I may give more weightage, some ratio I may give lesser weightage. So they have told adjust it We are adjusting it. Increasing it, yes, we are doing it. How much increase? Subjective call normally, but question has said 1% for 1%, 2% for 1%. Write this now. Increase KE by 0.84, deviation 0.84, increase by 0.84, deviation 0.18, increase by 0.36, double of 0.18. Why double? Question has told. It has said 1% for one time, 2% for one time. KE of this company. What was the KE of that proxy entity? Plus 0.84 plus 0.36. 10 point. 10.8% is the KE of our company. Any doubts on 10.8%? Can you proceed? Any doubts on this? Almost done. I'll quickly close it. Any doubts on this? Now, ideally, I will do D1 by K minus G. But they are saying, no, I don't want to get into all this. You assume this. Yield is assumed as what? 50% of profits distributed, 5% of undistributed profit. Yield equal to, right? Yield equal to 50% into. Look at the question and tell me what is the equity dividend paid. 8% of 80 lakh. 50% into 6 lakh 40 plus 5% of undistributed means from the overall EAES. What is the overall EAS? 12 lakh 60,800. From there remove 6 lakh 40. Remove 6 lakh 20,000. Now retain earnings portion. They have defined it in the question. I will go with whatever definition they have given in the question. Ideally, I would have taken only dividends. They are saying no. Take 50% of distributed profit, 5% of undistributed profit. Tell me the value. This is for the entire company. First, I will do entire company valuation and then I get per share valuation. Any doubts on 351,040? 50% of distributed profits, 5% of undistributed profits as per the question. They have defined it this way. Any doubts on 351? That's all. Value of company equal to 351 divided by some 10%. Okay, there is a doubt on repeating the yield steps. Yield has been defined in the question. 50% of profits distributed, 5% of undistributed profit. When I did this income statement, I could have gone a step ahead. Less equity dividend. What is equity dividend? 80 lakh into 8%, 6 lakh 40, and retained earnings 6 lakh 20,800. As per the question, yield is equal to 50% of dividends paid, 5% of retained earnings, undistributed profit. 50% of 6 lakh 40, 5% of 6 lakh 20,800. We got 351,040. I hope it is clear. Any doubts? 351,040 divided by 10.8%. This is the value. 351,040 divided by 10.8%. 3 crore. Sorry, 32 lakh. 32 lakh. If you divide by number of share, you will get the per share price. You divide by the number of share, you will get the per share price. Or that 351, no, that also we could have divided by number of share. At any stage you do, that's okay. 40 point. Some up and down rounding of difference can be there. 40.65. Okay, that's more of a small rounding of difference. Any doubts on this? Clear? Able to understand this? Practically, this is the best method of valuation, but giving justification for every item is challenging. As you become experienced, maybe whenever you do in a practical valuation, if you become experienced, you'll be able to give justification for every item. Clear? Any doubts on this? Done. So we are almost done with the equity valuation. Only one area is pending, which is the FCFE approach, which I will do. I think that is the only approach pending. Just give me a minute. Concept 27 is pending. Yeah, we are done till concept 31. Concept, that one concept alone is pending. Post break, I will do that FCFE approach, revise everything, and then we move to the balance segment. Clear? Okay, let's take a break. We'll resume at 10:30. Okay, let's proceed with the discussion. We have one more approach which is pending, which is called free cash flow approach. Let's quickly understand this. Free cash flow approach, the formula is FCFE1 by KE minus G. The actual formula is not FCFE1, the actual formula is D1 by KE minus G. So the name used is FCFE1, but the real formula is D1 by KE minus G. Let's understand what is FCFE. As the name indicates, it's called free cash flow for equity shareholders. What is free cash flow for equity shareholders? A company earns profits of 20 lakh rupees. Okay, I have earned profit of 20 lakh rupees and depreciation was there. Let's assume some 10 lakh rupees is there. So I have a cash flow of 30 lakh rupees. This cash flow, whatever I have generated, we will not be adding back depreciation when I do calculation. I'll explain as we proceed. But cash flow is 30 lakh rupees. I have three purposes for this: working capital, capital expenditure, balance. This 30 lakh what I had, I have a working capital requirement of 20 lakh rupees. I need money for working capital purposes. So I need 20 lakh rupees for working capital. Company has said we need 20 lakh, but we will not use from our profits fully. 10 lakh we will borrow. Another 10 lakh we can take it from the profits which is generated. Or 60% we will borrow, 40% we will take it from this. So I need 20 lakh rupees. In this 8 from profits, 12 from borrowing. So out of the 30 lakh which is available, 8 lakh is gone. Out of the 30 lakh available, 8 lakh has gone for working capital purpose. I want to do capital expenditure. Another some 20 lakh requirement is there. Let's assume 30 lakh requirement is there. Again, I decided same ratio. 12 lakh from profits, 18 lakh from borrowing. So out of the 30 lakh, 8 lakh is used. 12 lakh is used. We are left over have 10 lakh. This 10 lakh is called free cash flow. Free cash flow means there is no use of this money. There is no utility of this money. I do not have a purpose for which this is to be used. So in an ideal situation, an organization should convert this free cash flow as dividends. Should convert the free cash flow as dividend. When you do not have any purpose of the money, you should not ideally keep it. Practical world, organizations don't do like this. For example, most of the IT companies will not have any purpose, but still they'll keep retaining, thinking that in future I'll need money. And suddenly they'll do a huge buyback and all because they have so much money available. They'll do a buyback or they'll do a big acquisition. So what is free cash flow is cash flow available after meeting working capital requirement and capital expenditure. In capital expenditure, we have a term called net capex. This depreciation, don't add it. You adjust the capex figure itself as capex minus depreciation. The capital expenditure requirement which we have a term called net capex. What is net capex? Is capex adjusted for depreciation. There are many businesses which do capital expenditure and their capex will be almost equal to depreciation. In that case, what will happen? 10 lakh fixed asset goes down to 8 lakh, goes back to 10 lakh, goes down to 8 lakh, goes back to 10 lakh. 8, 10, this will keep happening. They don't need extra money. Depreciation, whatever is there, that money which is not paid will take care of my requirements of the business. So we use a term called net capex. What is net capex? Capex adjusted for depreciation. So I will understand like this. EPS is 10 rupees. Depreciation is 20 rupees. Capex is 30 rupees. Net amount is 10. Net amount is 10. So I need 10 rupees per share. Instead of giving overall number, I've given per share number. It's easier for us to do. 10 rupees I need for what purpose? For the purpose of capital expenditure. Then I need 2 rupees for working capital. 10 plus 2, 12 rupees is needed. My EPS itself is 10 rupees and I need 12 rupees. Obviously not going to be sufficient. Then there's a debt ratio. What is debt ratio? Is debt divided by capital employed. So debt ratio basically means if you need 12 rupees, debt will contribute 0.6. Equity will contribute only 0.4. Equity will contribute only 0.4. Debt equity ratio. Debt will contribute 0.6. Equity will contribute 1. Equity will contribute 1. Debt ratio means debt will contribute 0.6. Equity will contribute 0.4. So you need 12 rupees. In this 12, profit 4.8, 40% only. Balance is borrowing. So from the EPS, I need only 4.8 from the profits. Leftover money is called FCFE. Leftover money is called FCFE. That can be FCFE 0 or FCFE 1. This year means 0. Next year means FCFE 1. FCFE 1 divided by KE minus G. Technically, this is a superior approach as compared to dividend model. Reason? Dividends you can adjust the way you want. Suddenly you will pay more, suddenly you will pay less. FCFE cannot be adjusted by management discretion. Management cannot suddenly increase it, suddenly decrease it. But free cash flows, dividends can be suddenly increased, decreased, but free cash flows are something which the business is generating. It is not on the discretion of the management. Clear? Able to understand this? So in an ideal scenario, FCFE should be equal to dividends of the company. Should be equal to dividends of the company. So this is not a new model of valuation. It is already learnt as dividend growth model. The name is called FCFE growth model. What is FCFE? Is PAT minus how much equity. Equity means retained earnings. Retained earnings is part of equity. Equity funding for what? Net capex and working capital. Equity funding is net capex into 100% minus debt ratio. If they give debt ratio, I want a complicate question, I'll give debt equity ratio. Debt is so much, equity is balance, debt is 10, equity is 100. Debt equity ratio means debt divided by equity. Equity will be 1 time, debt can be 0.5, 0.4, 2, 3, 4, whatever they give in the question. Able to understand this? Any doubts on this? Clear? Let's see a question around this. Calculation, everything going to be very simple. It's just a 10-minute kind of a discussion only. Let's come to this. Question 28. It's a study mat question, but this para will not be there in the study material, okay? I added this from some other question. Numbers, everything will match, but this initial para may not match in the study material. Mr. Amit is happy with the investment in a company as it is paying good dividend for the last few years. Last year, it paid a dividend of 2 per share. Share is currently trading at 150 per share. He is of the view that if he applies dividend discount model, what is dividend discount model? Gordon model, the share is undervalued. As a financial expert, examine his view that dividend discount model represents fair value. This came added in some other question where they compare dividend discount model with the FCFE model. Superior is FCFE model. You being an expert is required to evaluate the market value of the share of the company. Various data is there. First, let's do dividend discount model. What is dividend discount model? P naught is equal to D1 by KE minus G. Dividend is given in the question. KE will be somewhere there and we complete it. What is the data they have given? Profit of the company, equity capital of the company, par value of share, debt ratio, long run growth rate, beta is given, risk-free interest rate is given, market return is given, capex, depreciation, and change in working capital. Let's start doing it. Nothing much for you to read. First, do dividend discount model. Now, write K is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. RF plus beta into RM minus RF. What is the RF given in the question? 8.7 beta. RM minus 8.7. 8.86%. Any doubts on this? P naught is equal to D1 KE minus D. 2 plus some growth rate is given in the question. How much? 8%. We may get a huge answer. Minus 8%. Some 251 rupees we are getting. Clear? So I applied the model. Model gave me answer 251. Question is giving the values only at 150. So he is thinking, why is this happening? Share should quote at 251 rupees, but share is quoting only at 150 rupees. Then he is saying, he has given us extra information. He is not saying we have to evaluate. Whenever question gives depreciation per share, capex per share, that is an indication you have to do FCFE approach. For doing FCFE, we have to do earnings per share minus equity needed for capex and working capital. Equity needed for capex and working capital. Let's do this now. FCFE is equal to EPS minus equity for net capex and working capital. We'll do 4 decimal. The numbers are going to be small, so we'll do 4 decimal calculation. Equity for net capex and working capital. What is the profit made by the company? 290 crores. Give me the number of equity share. Number of equity share. 1300 crores by 40 rupees each. By 40 rupees each, which is 32.5. 290 divided by 32.5. This is my EPS. Minus equity needed for net capex and working capital. Any doubts till this? Now, how much is the capital expenditure we are going to do? How much is depreciation? Net of 8 rupees. Net of 8 rupees. Capex is only 8 rupees. Okay. My fixed assets will go up only by 8 rupees. It will not go up by 47. Go up by 47, go down by 39. 8 rupees only the balance sheet will increase. 8 rupees is fixed asset increase. 3.45 is working capital increase. 8 and 3.45. How much is the debt ratio? 27, which means equity has to contribute 73. Equity has to contribute 73%. Equity has to contribute 73%. So 47 minus 39, 3.45. Net amount is this into 73%. This is my FCFE. Give me a 4 decimal answer. After subtracting. .5646. Now, in an ideal situation, how did company pay dividend of 2 rupees? I am not able to understand, because your FCFE is how much? 5646. Instead of using the money for your business purposes, you have ended up paying more dividend. That is why Gordon model may not give the right value of the company. Gordon model, 2 rupees dividend is on the higher side. Ideal dividend is 56 paise. Ideal dividend is 56 paise. How did I pay 2 rupees? Maybe I reduce capital expenditure, or I reduce working capital, or I borrow more money. Ideally, I should have paid only 56 paise. Any doubts on this? Value P naught is equal to FCFE 1 KE minus G. 5646, add 8%, assuming this is 0, 8.86 minus 8%. This is the right value according to the model. You get some 70 rupees something, 70.90. Ideal value is this. Why are we getting extra value in the other model? Reason was we paid more dividends. That is something which can be adjusted by a person. The MD of the company, CFO of the company can adjust the dividend figure. How they paid extra, we don't know. So which is where this comparison will be there in the end. From the above, we can say that value is more than the value on free cash flow to equity model. Analysts consider expected dividend. In case of stock is valued based on only cash flow for distribution. Using free cash flow provides a better measure of valuation. Provides a better measure of valuation in comparison to dividend discount model. Thus, the view discount model represents fair value is incorrect. The share is not undervalued, rather it is overvalued. Rather it is overvalued if we take which approach? Free cash flow to equity model. In the ICI study mat, this comments and the earlier part will not be there. They just asked it. In one MTP, they suddenly added this in between saying that you do a comparison. Clear? Able to understand this? Any doubts in this? Quickly get answer to this. You have to do calculation, very similar one. I'll give you around 4 minutes. Sorry, take 5 minutes. I'll start doing it in some 2-3 minutes. I will do in 2-3 minutes. You start doing it as of now. Almost the same thing only with some changes. You keep doing it. In the side, you will see the calculations being done. You complete and then check it. I will start explaining it in a minute. I wanted the FCFE number and then you get the answer. That's getting the answer is more of a formality. Main part is getting the FCFE correctly. A slightly different question. Earlier question, everything was given per share. Here, everything is given overall. That's all. That's the only difference. Okay, I'll quickly discuss EPS 8,000 minus income tax because the given is before tax divide by 380 crore 14.7368. Net capex and working capital is capex minus depreciation plus working capital, which is 4795.60. In that, borrowing is 2062, balance 2733 is equity, and equity per share is 7.1934. At a per share level, you need, and final answer is 7.5434. 7.5434, whichever way you do, presentation can change, but final answer is 7.5434. Beyond this, I'm not discussing it. If there are doubts, let me know. 7.5434. I'll repeat again. Net capex, profit minus tax, 5,600 by 380, 14.73. Net capex and working capital is 4795. In that, 2062 will come from debt, guys. 2,733 from equity, guys. At a per share level, it is 7.1934. Any doubts on this? Clear? Can we proceed? Can we proceed? With this, my discussion on equity side is over. Any doubts on this? Can we proceed? Clear? Done? Now, I'll quickly revise whatever we have done till now in the equity side. And once this revision is done, I will not discuss about equity later on when I do the other parts of the chapter, because revising totally some 80 concepts are there. Together doing 80 will become little challenging for you to absorb also and for me also to explain. We are done with one segment of the chapter. We started with time value of money, where is you have a present value which is divided by 1 plus r power n, future value multiply with 1 plus r power n, annuity multiply with future value. Guys, you can come out of that question and focus now on this future value annuity factor, present value annuity factor. In case you need any explanation on the previous question, you tell me. If you need explanation, because otherwise let's move here. Okay. And perpetuity valuation is Gordon's model, D1 by KE minus G. Next year cash flow valuation happens a year in advance. Walter's model prices, what is paid out, D by KE, what is not paid out, R by KE into E minus D divided by KE. What is optimum payout ratio? Comparing two items, dividend and cost of, return on equity and cost of equity. Return on equity more than cost of equity, growing company, no dividend. Lesser, declining company, 100% dividend. Equal, we are indifferent. Limiting value means following a payout ratio, which is opposite of the optimum payout ratio. How do I value share under Gordon's model? D0 into 1 plus growth rate by KE minus G, D1 by KE minus G, PE1 into payout ratio by KE minus G. By now, by solving question, you would have understood that it is difficult to sometimes to know whether it is D0 or D1. Assumption will only help if there is no clarity. If clarity is there, paid out, paid now, or will pay now, all that is current year dividend. Will pay next year, end of current year, all that is next year dividend, D1. How do I calculate growth rate? ROE into retention ratio, or comparing one dividend with the another dividend, or comparing one EPS with the another EPS. Return on equity formula is EAES by amount of equity, or EPS divided by book value per share. Cost of equity is what an investor wants. D1 by P naught minus F. You see that minus F is there in the cost of equity formula. P naught minus F plus growth rate. If it is a non-dividend paying company, RF plus beta into RM minus RF. Or you can also do 1 by P multiple if it's a 100% dividend paying company. If you do any new project, good project, market cheers for it and gives you extra price. bad project, market punishes the company, share price will go down. So share price will go up by the amount of NPV per share and go down by the amount of NPV per share. Undervalued or overvalued, you do calculation, that's called fair market price. Question gives a number, that's called actual market price. If your fair market price is 100, actual market is giving only 80, undervalued, buy it. Market is giving 120, overvalued, sell it. How do I move from one year to another year? P1 is equal to P0 into 1 plus KE, 1 plus KE minus the dividend of first year. Second year, P1 into 1 plus KE minus the dividend of the second year. Dividend investing, this is an objective which some people will have where they want to get regular income. Company pays, very happy, I get the income. Company does not pay, I'll do partial sale of shares. Holding period return is P1 minus P0 plus D1 divided by P0 into 100, or NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 100. X-dividend value and cum-dividend value, for all our calculation purpose, I will use only X-dividend value. X-dividend means value post dividend. So if the value is cum-dividend, remove the dividend component, get the X-dividend value and do any KE calculation. If you have arrived at a fair price, you arrive at X-dividend value, compare with the X-dividend actual value and then decide buying or selling. Inflation premium, any required return of a security has two parts. One is your risk-free rate and second is your risk premium. Risk-free rate has two parts, inflation and real rate of return. Any increase in inflation premium will increase my risk-free rate, may also increase the market rate. Step-up growth model says there are multiple growth rates in a company. When you have multiple growth rates in a company, the Gordon's formula fails. P not equal to D1 is not possible. D1 is okay, but K minus G is not possible because you have multiple growth rate. So you have to wait till it stabilizes. Calculate dividends for first year, second year, third year, fourth year, fifth year. Stability happens. P5 equal to D6 by K minus G. P6, D7 by K minus G. Discount year 1, 2, 3, 4. Fourth year, if it stabilizes, fourth year will be written 2 times. That is fifth year, if it stabilizes, fourth year will be written 2 times. Last year, you have to write it 2 times. One is dividend, one is price. The question may ask you to value the share. Question may ask you the growth rate. Question may ask you the your dividend number. It may also even ask you for a cost of equity computation. Change in growth rate with the change in payout ratio. If there is a change in payout ratio, you should not directly do dividend. You have to do EPS, and based on EPS, you have to do DPS. EPS as well as dividend per share. Linear fall in growth rate. In case there is a linear fall in growth rate, they tell number of years of fall, great. If they say that, then higher rate minus lower rate divided by the number of years of fall. Like fall, it can be increase also. There was a payout ratio where it was increase. Find out the every year fall and keep deducting it. Number of years not given, every year 1% fall. H model basically says that if you have multiple growth rates, you first assume that stability happened today itself. So D0 into 1 plus normal growth rate divided by KE minus normal growth rate. Same denominator for the second part of the formula, but start with today's price, give benefit for the extra growth for half of the transition period. Half of the transition period. P multiple approach, EPS into P multiple equal to 1 by KE, 100% payout, or 1 by ROE. Assumption is BVPS is equal to market price per share. Earning growth model, E1 by KE minus G. Impact of bonus, if there is a bonus issue which happens, the ultimate selling price will not be for 1 share, it can be for 1.5 share, 2 share, 2.5 share, depending on the bonus. Keep that in mind, and also keep if any transaction costs are there. And if there is a transaction cost, no transaction cost, maximum purchase price is equal to fair value of the share computed by us. But if there is a transaction cost, then what we need to do is fair value divided by 1 plus the transaction cost percentage. GDR is basically same as equity. Instead of issuing it in India, I want to issue it in US for my US investors. So I deposit something here. There will be a share to GDR ratio. There could be an underlying discount I give when I make an issue, and there can be a flotation cost. K is equal to D1 by P0 minus F plus G. You can call this KGDR, cost of GDR. If it's a dividend paying company with multiple growth rates and you want to calculate cost of equity, start with one initial guess rate, year, cash flow, PVF, DCF, keep writing dividends, value the share at some point of time. You do this example where it's only 2-year calculation. Do this, you'll get positive NPV, increase the rate. You will get negative NPV, 1 positive, 1 negative will give us the IRR rate. Free cash flow approach basically says that Free cash flow represents the money where there is no need for the business. If a business doesn't need something, it should ideally go ahead and give it to the shareholder. It should ideally go ahead and give it to the shareholder in the form of dividends. So FCFE is equal to EPS minus equity needed for net capex and working capital. Net capex is gross capex minus depreciation. What is equity needed? Your overall requirement into 100 minus debt ratio. And if they give debt equity, then split in the ratio of debt is to equity. Format of income statement: start with sales, deduct COGS, get gross profit, deduct expenses, get operating profit, interest. Interest can be calculated as respective debt into respective rate. And if they give an effective rate, directly take that effective rate on the entire debt figure. A lot of ratios are there. I'm not discussing that. And we had fixed interest and fixed dividend coverage ratio. This is not a very logical ratio. If at all it comes, you will anyway remember it: PAT plus interest divided by interest plus dividend. What is the purpose of doing all this calculation? Compare our ratio with the industry ratio, find out the deviation. Deviation could be weaker, could be stronger. Weaker, increase KE; stronger, reduce KE, and then end up doing the valuation. Any doubts on this? With this, my discussion on share valuation is over. Discussion on equity valuation part got over. Any doubts on this?